Hey everybody, welcome. This is the Crypto Crow. Now, before you get into this master course video explaining to you about crypto, I wanted to let you know that I have a free PDF. This is in a magazine style format PDF that basically covers just about everything and more that I cover in these videos. Everything from the technology behind Bitcoin, the market cycles. There are a lot of notes and tidbits of information that are probably not in these videos. And this is all to help you better understand the cryptocurrency space. The PDF is interactive, where a lot of the links and images are clickable that take you to different places on the web. You can see I break down a story, how I bought my 2022 Cadillac Escalade for $3,000. I explain how I did that, and that's real. I did do that. I bought that when we first moved here from Puerto Rico, and I explain exactly how that was possible. Basically, right now, I'm giving this away. This is all for free. This is all me trying to help all of you understand the cryptocurrency space. I don't want anything from you. I don't want your money. I don't want your crypto. If I ever contact you on social media telling you I have an opportunity or something to that effect, it is not me. It is an impersonator. Be wary. But this PDF guide, it's free on my Ko-Fi account. I encourage you to just click the link in the description below, download this PDF for free. You can tip if you want, but it's not a requirement whatsoever. But enjoy this, use this. Send this to all of your friends. If you're men, make sure your wives take a look at this and read it so that they understand why you're pumping so much money into the cryptocurrency markets right now. And just read through it all. And then this will basically become a catalyst for you to continue furthering your own research. And with this PDF guide, as well as the video that you're on right now, you should learn a really solid basis from which to grow your cryptocurrency knowledge and basically how to prepare for the 2024-2025 market peak and into the 2030 cycle, which is probably where you're really going to shine. So until then, enjoy this introductory course to cryptocurrency for beginners, and I'll see you soon. Grow your coins. Greetings, ladies and gentlemen. Welcome. I am Jason Appleton, otherwise known on YouTube as Crypto Crow. Now, I began in the cryptocurrency space back in 2017 while I was actually in the middle of developing mortgage bank branch offices in Cincinnati and Northern Kentucky. Now, this course is going to be a combination of everything that I've learned since 2017, the ups, the downs, the market cycles, the projects, and pretty much everything in between. I'm going to keep this course more flow-based instead of scripted and regurgitated for the sake of nausea, quite frankly. I see a lot of courses out there that are not necessarily as conversational, but more very A to B to C to D, and I tend to tune out on a lot of that kind of stuff. And so I figure I want to make this course a little more conversational, a little more steadily flowing, instead of a scripted, recorded, very, very edited type of course. I feel like you're going to learn a lot more if it just feels more natural. That's how I prefer to learn, if anything. I will also say, investing in the cryptocurrency is always super risky. We're still in the infancy of the disruption era, if you will. And that being said, while the profitability potential for cryptocurrency is still insanely huge, which you're going to learn, it's still always very risky because you never know, from one day to the next, your favorite project could become worthless due to some mishap, a hack, anything could happen, regulation, you name it. So it's always very risky, but the more you know, the more you educate yourself, the more you understand what's happening, what's likely to happen, and what has happened in the past, the better you'll understand how to establish your fundamental basis for growth as we continue forward in this 2022 bear market cycle and prepare for what's to come in the next bull market cycle and then on. So this course is really going to be highly informative, highly educational, and honestly, the most comprehensive crypto course I've ever done. I've had over 12,600 students on Udemy alone, and a lot of five-star reviews. If you watch my YouTube streams, you see a lot of people who thank me for changing their lives. I'm going to be very honest with you and tell you that a lot of what I say can be seen for free on YouTube. However, this course is going to be much more specific, much more focused, and be broken down in sections and chapters. I think right now I have over 40 planned. There's likely going to be probably 50 by the time all is said and done. You're going to learn everything you need to know to be successful in crypto. So, and honestly, at a price point that it makes it justifiable for me to put in all of the time, cover expenses and things of that nature, but ultimately at a price point that you can't scoff at. Now, here's the thing. I started back in, oh gosh, I forget what year it was. Bitcoin was $4,000. It was the low. I think it was around December of 2018. And I tried to set up a huge convention in the Cincinnati area about Bitcoin and about crypto. And I had some of the best speakers from all over come in and do favors for me. Kiana Danielle, a lot. Okay. And these are people that you'd probably recognize. And if you're in crypto at all, or even in the finance sector or trading, I had a lot of people that flew in on their own dime to speak and educate people when the market was lowest. And ultimately, my goal was to educate newcomers to the space and prepare them at a $4,000 Bitcoin price point for what I saw coming, and ultimately ended up being a $65,000 Bitcoin peak at the end of that bull cycle. Here we are, a full cycle over. We're in a bear market, and I'm trying to do the same thing now. Only this time, I'm not shelling out $50,000 to put on a convention that everyone ignored. So this is one of those things where you're going to get out of it what you put into it. This isn't about getting rich quick. This is about education. This is about you truly understanding the cryptocurrency space, how to use it, how to more or less properly speculate on it, how to trade it, mining, master nodes, every element of cryptocurrency you're going to learn in this course. So without further ado, I hope you enjoy this. I hope it helps you. I truly, from the bottom of my heart, aim to try and change your life for the better in everything that I do, everything that I share, and every thought I express. Granted, I'm always right sometimes. So with that being said, not every project I love, not everything I touch is going to turn to gold. Not everything that I do is going to be worth millions of dollars. But it's really up to you to take what I teach you here to point you in the right direction, to start formulating your own expertise, your own wisdom, and your own experiences as you move forward in the cryptocurrency space. So I'll see you on the inside. Thanks for being here. And ask me any questions. I'm always around. Until then, crow your coins, and I'll see you in the first lesson. All right, welcome, ladies and gentlemen. Now, the first lesson of this entire master course is fundamental in a lot of ways. And what we're going to start with is an understanding as to what Bitcoin actually is. What does it do? Why the big hoopla? Why is everybody going goo-goo over Bitcoin? What can it do for you? What can it not do for you? And ultimately, what does the technology mean? So the first thing I'm going to explain, and I have videos and graphics and all kinds of things throughout the course. It's not just going to be me talking into the mic, just so you know. But ultimately, when you go to the bank, okay, the bank basically maintains a ledger system of your money. Your inflow, your outflow, deposits, what you spend, whether it's through your checking or your debit card, and they basically manage a centralized ledger system. And it keeps the checks and balances of your account. Now, what is prone to these banks are bank errors. Somebody fat thumbed a zero or took too much money out, or, you were charged too many fees for this reason or that reason. And all sorts of things happen in centralized banking systems and the banking systems alone have created such a hysteria associated with banks loaning more money than they actually have. And, if too many people were to try and withdraw from a bank all at one time, it would create a lot of problems, right? Because they don't actually have those funds. And with recent laws passed, basically citing banks can loan, they don't have to have any reserves. Ultimately, if I put $100 in the bank, they can loan that out. and not have to maintain any of it for repayment or anything. The other side to that is banks oftentimes will loan money to other banks. So now the same $100 deposit that I'm putting into this bank can then be loaned out, and then it can be loaned out by the next bank and the next bank. And before long, it's been loaned out 300-400 times, however many times. And you have a lot of banks loaning out money that doesn't even exist, which creates such a significant problem. Now, back in 2008 and 2009, a technology was formed. Now, the origin of this technology is still unknown to this day. I have theories on who invented the technology, whether it was a group of very intelligent technology junkies or it was one lowly person somewhere in some other part of the world. Nobody knows for sure. I believe ultimately it was created by a team of technologists who were ushering in a new trackable technology, which is ultimately called Bitcoin. Now, Bitcoin is a peer-to-peer system that eliminates the middleman. It eliminates the banking systems altogether. You're ultimately able to send money or value from point A to point B almost instantly with minimal fees anywhere in the world. It's from wallet to wallet. That's it. It's immutable, which means once it's minted to the blockchain, it can't be changed or altered in any way. On top of that, due to its decentralized nature, you have nodes operating and maintaining this blockchain scattered all over the world, and over 51% of them have to agree on a particular transaction for it to be minted into the block. Okay, now we're going to start getting into some images here. This is it's like an original picture of the Bitcoin blockchain, dated and named Satoshi Nakamoto of October 31st, 2008. Now, the original Bitcoin white paper can be found all over the place. This is on bitcoin.com. And ultimately, you can learn all there is to know about this technology, how transactions work, what's the nature of it. But ultimately, it's an immutable, trustless system whereby people can send value from point A to point B instantly with minimal fees. That's ultimately what it boils down to. And the network is maintained by a network of computers or nodes, if you will. These computers are what we call mining. So these transactions that are being processed on the blockchain are ultimately being confirmed by these miners. And anytime one of these mining nodes or mining computers mints a block of their own, they are rewarded in Bitcoin. Okay, so what happens is all these computers, now you might hear about mining farms, basically mining in big buildings full of ASICs miners. It's because the technology has to get faster and faster to continue mining competitively on a blockchain that ultimately gets more difficult about every 6 months based off of how many miners there are, the hash rate. This is all stuff that we'll get into a little bit here. The hash rate, which is how much mining power or processing power is mining up these transactions, and several different variables. And these mining farms are basically hundreds of different mining computers working in the same pool, so that if one computer gets a block or mints a block on the chain, all of those mining operators are sharing in that reward, because ultimately you're increasing the likelihood of minting a block by pooling a bunch of computers together, mining together, sharing the rewards of all of their work, rather than just have one computer on the system mining, hoping someday it manages to mint a block amongst the thousands and thousands of ASICs miners that are out there mining. So let's go through this. This is a graphic explaining how blockchain technology works in a nutshell. So step one here is a transaction is requested, whether it's sending value or receiving value for the most part. The transaction is broadcasted to a peer-to-peer network that consists of computers, otherwise known as nodes. The network of nodes uses known algorithms, which in the Bitcoin case is the SHA-256 algorithm, to validate the transaction and user status. These algorithms are ultimately cryptographic solutions, ciphers that are used to encrypt data that gets basically pushed out to all of these nodes. A verified transaction can involve cryptocurrency, contracts, records, or other information. Contracts is not a thing with Bitcoin yet. For the most part, it's basically just a peer-to-peer value transaction network. Smart contracts didn't get introduced until Ethereum, which we're going to talk about in the next video. Number 5, the transaction is combined with other transactions, once verified, to create a new block of data for the ledger. At number 6, the new block is added to the existing blockchain, which is permanent and unalterable. Number 7, the transaction is finished. So ultimately what you have is a network of computers working together to confirm these transactions and make sure that nothing's being fiddled with, nothing's being altered mid-process, so forth and so on. And ultimately eliminating the middleman altogether. You don't need banks with a decentralized blockchain ledger system. And there are different variables to how a ledger system may be made up, which is what opens up the door for new technology. In other words, if you look at the SHA-256 algorithm or Bitcoin blockchain, the way it operates and the way the blockchain in the ledger system is structured, it may be very different to Ethereum, which originated on like the ERC20 algorithm, or you have HBAR, which is a completely different system altogether. But ultimately, the same bodes true for all of them. They're more or less peer-to-peer networks of computers working together to solve these problems, and the people that are putting up the money to have this hash power to confirm these transactions on the blockchain, constantly mining, if you will, they're rewarded in Bitcoin. Now, the mining infrastructure that has been coded into the Bitcoin algorithm is one that automatically cuts mining yield in half every 4 years. And we're going to go into that in the market cycle lecture of this course. But these halving cycles play a significant role in the current trend of bear and bull market as it relates to cryptocurrencies. Outside of all of the macroeconomics and the global news and so forth and so on, there is a hard-coded halving in the blockchain. So every 4 years, without fail, Bitcoin mining is immediately cut in half, which means if there's 1,000 miners out there in the world and they are mining up this Bitcoin and we reach a point of halving, well, if those miners were mining up, 20 Bitcoin a day, well, now those same 1,000 miners are only mining 10 Bitcoin a day, which ultimately lowers the supply as education and demand increases, ultimately creating these bull market cycles. Okay, so that's ultimately Bitcoin in a nutshell. Currently, it's trading at 16,700 thereabouts. We're in a bear market. We just reached new lows today, as a matter of fact, which I took as a signal. And we're going to get into a lot of the stuff and how and how this stuff works. But ultimately, yeah, you can see it right here. Bitcoin's currently trading at 16,791. It's going up and down a little bit on a regular basis. And if I go down here, you can see the peaks of the various bull market peaks. The most recent one I called on Twitter as I called the peak to the day. And I said there were, in that same afternoon, I said we're going to have a 2-peak cycle. And there are reasons for that I'll get into later. I was one of the few people out there that actually called this 2-peak cycle. So pat on my back. As I always say, I'm always right sometimes. So hopefully this at least gives you a fundamental understanding as to what blockchain technology is, how it works, what it means, and ultimately how we have then grown from the original Bitcoin technology, the algorithm, the mining cycles, all that stuff, and how it's grown into new technology, which leads us into Ethereum, which is the next lecture. I'll see you there. In this lecture, we're going to talk about the next generation, the second generation of blockchain technology after Bitcoin, which is Ethereum, ultimately. Created by a gentleman named Vitalik Buterin, Ethereum was ultimately coded as an answer to create more use case functionality out of the blockchain. Whereas Bitcoin was basically a peer-to-peer system for sending value from point A to point B in direct transactions, Ethereum introduced ultimately technology-changing technology in a smart contract. So when you're talking about Ethereum, what comes to mind? Well, for me, initial coin offerings is what comes to mind. And I'll explain some of that soon enough. But ultimately, Ethereum added the ability for an if this then that kind of methodology to creating these smart contracts. If this happens, then that should happen. And that technology ultimately created the means for initial coin offerings, which were a way for people to invest in tokenized projects by sending Ethereum to a wallet address and receiving alternative coins in exchange that were also on the same algorithm, the ERC20 algorithm. And the technology itself started as a proof of work system whereby machines like this behind that you're looking at this is a 6 GPU machine. Bitcoin uses CPU processing power for their mining algorithm, whereas Ethereum on the ERC20 algorithm used GPU power ultimately. I've built 2 of these rigs myself, and I've actually put out a video on how I built the most recent one step by step with all the equipment and everything else, but you're not going to need that anymore because Ethereum has recently changed to Ethereum 2.0, which is now proof of stake. So the difference is proof of work is you buying all this expensive equipment and it just pumps out all this hashing power and you're mining up transactions very similar to the way Bitcoin does. With proof of stake, well, that's a little bit different. Proof of stake is you take your tokens, you lock them into a contract, and you're just passively rewarded over time with new tokens as transactions and throughput continues to grow on the network. Ultimately, it's greener in the sense of, climate change and, wasting of power and things of that nature. So it's potentially a good move. But in another topic, we might get into why proof of stake and this ETH 2.0 merge for Ethereum isn't necessarily such a great thing. Things related to censorship and things of that nature have come to question recently. But ultimately, what Ethereum has done is they've taken this peer-to-peer technology and they've opened it up for these contracts. And these contracts can be anything. It could literally be anything. It could be a mortgage loan for that matter. It could be as complex as you want it to be. Ultimately, it depends on the programming, which Ethereum programming is done in Solidity. And a lot of programmers have done very, very well for themselves over the years, developing these smart contract-based applications on Ethereum. The next level to this is security tokens. So what happened was with Ethereum's launch and its big claim to fame, which were these smart contracts, you had companies all over the world launching these projects, okay? And we're going to get into more detail on what these projects are and how to navigate them in coming lectures. But in a nutshell, these projects, the majority of them turned out to be scams or, early seed capital stage startups that didn't go anywhere. The market cycles associated with Bitcoin and cryptocurrency in general play a significant role in projects, their growth, their ability to establish use case and establish user adoption to a degree that ultimately merits the growth of the token's valuation. Okay, there's a whole system for this I'm going to explain in the future. But this is primarily just about Ethereum, and ultimately it was created not just by Vitalik Buterin, but it was also created by Gavin Wood and Charles Hoskinson, which we're going to show in the next video as we dive into Cardano, which is ultimately my favorite blockchain, my favorite token, ADA. Even my cat is named Cardano. Okay, so it's treated me very well since I got in December of 2017, and I've helped educate many people on it. But Cardano ultimately took Ethereum and made it better, made it faster, made it cheaper, and all sorts of things that we're going to go into in the Cardano video. But ultimately, Charles Hoskinson broke away from Ethereum because there was a discrepancy, I guess, if you will, or a misunderstanding, or they just simply didn't agree on the direction of Ethereum, where Ethereum was meant to be launched as more of an open source platform, not necessarily a corporate vehicle for growth and prosperity in that sense. Vitalik is a very forward-thinking individual, very eclectic, very artistic, I guess you will, if you can be artistic as a programmer. But he's very much a programmer. You can watch watch videos of him talking all over the place. He's a smart fella for sure. I happen to think he's quite interesting. You know, he's yeah, he's an interesting character. You might want to check it out. But anyway, in a nutshell, that's what Ethereum is. It opened up blockchain technology to smart contracts and create these trustless contracts that say, if this happens, then that happens, and what can you build with it? And a lot of different applications have been built on the ERC20 blockchain. Pretty much, I would say the vast majority of tokens between 2017 and 2021, for the most part, were created on the ERC20 blockchain, including games, applications of all kinds have been created on Ethereum. One of the biggest problems that Ethereum created, though, is its cost. With gas fees being every time you send a transaction, whether it's on Bitcoin, Ethereum, or any other blockchain, to send those transactions, you need the parent token for that blockchain to function. In other words, if you're going to send Ethereum from one point to another, there are fees associated with that. Well, through congestion of the blockchain, increased usability, and the limited scalability and throughput of Ethereum, it would create these bottlenecks. These bottlenecks would ultimately create exorbitant fees where you could try to send $10 worth of Ethereum and it might cost you $200 in fees to do that. That's typically what would happen at the height of a lot of bull cycles, as hype, FOMO, all of this energy is coming into the blockchain and people are trying to use it. New projects are launching, popular projects continue to grow, NFT collections, you name it. And it just got to the point twice now in 2017 market and the most recent 2021, the same thing happened, which I believe is one of the big reasons why Ethereum decided to merge the blockchains, create this 2.0 variant, and move forward in a proof of stake model over a proof of work. There are a lot of different things associated with that for another time. But ultimately, Ethereum is, in my, I don't even really think it's opinion, but Ethereum definitely paved the way for the technologies that we see now, including third generation technologies such as Cardano, which is what we're going to discuss in the next video. And here we are talking about third generation technology, which ultimately is a way that developers have created methods for speeding up blockchains, increased functionality on smart contracts, throughput, everything. Okay, so when we talk about third generation blockchain technology, we went from Bitcoin to Ethereum to Cardano. In my opinion, there are other blockchain projects out there. There are hundreds of them. I was an early proponent of Cardano back in December 2017, which is where I did my first video about Cardano after reading their white paper. Basically understanding the technology behind the white paper and getting a really solid grasp as to the goals and the mission of this blockchain and what it stood for, what it was trying to accomplish, which is ultimately global use case across all industries, not just I guess you could say a niche blockchain use case. Some blockchains favor themselves as the blockchain for gaming, some other blockchain for finance, so all sorts of different things. Cardano, on the other hand, has been created to take all of the issues associated with Ethereum, patch those holes, and create a better blockchain. That was ultimately what had happened. And it's still ultimately in development. Some of the final milestones associated with it have not been launched. Now, in the grand scheme of things, IOHK, well, the founders and the builders of Cardano are three different companies. The primary development arm is Input Output Hong Kong, or IOHK, which is founded by Charles Hoskinson, who was originally on the Ethereum development team and broke away from Vitalik and Gavin Wood. Gavin Wood broke off and created, I think it was Polygon, which is much more of a niche blockchain in my opinion. And then Charles created Cardano. Now, in addition to that, they created the dataless wallet, and we're going to have videos on the dataless wallet, how to use it, sync it, all of that stuff in the future. A lot of the finer details in this course are going to come after these introduction videos to blockchain, just so that you understand. But dataless wallet is actually like a full node wallet, meaning it's slow. It takes a long time to sync up because every time you use it, you're downloading and syncing up what's on your computer with the latest of the blockchain. So you're downloading and operating and maintaining ultimately the entire Cardano blockchain when you're using Daedalus. Now, there are browser-based light wallets such as NAMI and others, which I'll show in the future. And there's a new one that's coming called Lace. This is being put out by IOHK, which I'm very excited about personally. Can't wait to start using. You've got a Tala Prism, which is a self-sovereign identity platform and service suite offering verifiable data and digital identity solutions, which we all know the right things are going in our world. We're going to be using this all over the place. Then you have Project Catalyst, which is ultimately Cardano's venture capital arm. And not only is it the venture capital arm, but it is I guess you could call it a decentralized venture capital arm, in that when projects are looking to get capital for startup, rather than go to the public and say, hey, send us money, and having an ICO, you're able to submit a proposal to Project Catalyst, and Cardano holders are able to vote on which projects they think should get funded and why. And that is a significant thing that Cardano does. I'm not sure any other project or blockchain out there does. So this is something unique, and it's very successful. It's funded, I think, every quarter. And it's ultimately put out there so that developers can create new use cases on the Cardano blockchain and actually get a seed round boost in funding to do it. I'm personally building a social media platform on Cardano, and we're going to be submitting a Project Catalyst submission here pretty soon, I think before January. Marlowe, which is an open source domain specific language and product suite designed to streamline the creation of financial smart contracts. And then you have Plutus, which is a smart contract development language based on Haskell. So, where Ethereum was created using Solidity, its own proprietary kind of new programming language, which is brilliant. A lot of Cardano is being developed in Haskell, but also being developed in a way that a myriad of programming languages can be used to create smart contracts and applications on the Cardano blockchain. So that's a pretty big deal. This is the Project Catalyst website, and then there are active campaigns that are going and so forth. It's actually pretty cool stuff. And this is one thing that you don't see on the Ethereum blockchain. This is actually Cardano, a staking rewards calculator. See, with Ethereum, one of the differences in Ethereum to Cardano is, with Ethereum, you used to be able to it used to be proof of work, where you buy all this equipment and start mining up Ethereum, and it would heat up the entire house. It'd get really hot. It would cost a lot in power to maintain 6 GPUs humming and purring away for hours on end. I've literally used an Ethereum hardware miner as a fireplace at one point. It will quite literally heat up an entire floor of your house. But when it switched to staking or proof of stake, well, now you have to lock up your Ethereum for a year or more just to get a passive yield on that. With Cardano, you don't have to do that. With Cardano, you are staking, whether using like the Daedalus wallet, you're staking to node operators, such as the Crow node, which is my own personal node I've been operating for years now. And people can delegate their ADA for a passive yield. And on top of that, it's not locked. When you've delegated your Cardano, it's based off of epoch. So you might delegate your Cardano or your ADA tokens today, you'll start seeing rewards in about 2 weeks. And then if you decide to spend some of it, well, then your rewards would be a little bit less 2 weeks later, because the algorithm will see, oh, you have less Cardano, you're not staking as much. Okay, that's fine. No penalty there, but you're just not going to get as many rewards the next time around. That's how that works. And there are calculators out there where you can say, if I put in this many ADA and I delegate it to this, approximately how much will I generate in a passive yield every epoch over time? And ultimately, it's roughly around 4.5%. So if I put in 1,000 ADA and I delegate that to a node, I stake that to a node, I'll get about roughly 4.5% yield on that a year, but it's broken down into epochs. So about every week and a half or so, I'll see more Cardano in my wallet than I did before. And there's so much to get into about Cardano, and I don't want this whole course to sound like it's a Cardano course, so I have to be careful. It's currently trading at 34 cents from a high of $3.14 in the last bull peak. and that's just fine by me. A lot of people, like I've been in it since 2017. When I originally got in, it was 33 cents, went all the way up in the first peak of the cycle and peaked out at $1.33 and dropped all the way down to like 2 cents, which is where I ultimately started gobbling up even more. And I started really hitting it into high gear, trying to educate everybody as best I could on, listen, this is Cardano. This is what I believe it's going to do. I could be wrong, but I'm going in big. I really love this project. I like Charles Hoskinson. I like what they're building. Everything, the tokenomics of it, all of it. I'm like, I think this is going to go somewhere. And I've been holding strong all these years, doing regular content about Cardano. Now you see half of YouTube talking Cardano all the time because the Cardano community is extremely strong. And the technology is such that it's ultimately creating methods for people in all industries to be able to benefit from this very decentralized blockchain, one of the most, if not the most decentralized blockchain next to Bitcoin. And ultimately, and see, the thing of it is, one of the key points in decentralization is there's no one point of failure. So if something were to happen, let's say we've got this network and, we have nodes all over the world. We'll use Cardano as an example. Let's say there are 3,000 node operators scattered all over the world, and something happens in one part of the world where a bunch of these nodes go offline. Well, guess what? The remaining nodes will take over and maintain that blockchain. So you don't have to worry about, basically for these decentralized blockchains to go down, there would have to be like a global power outage, a global EMP blast, or something like that. It would have to be taken out on a global scale, not a local scale, which is one of the reasons why it's much safer than, like if you saw the movie Fight Club, where they're watching the credit towers or whatever going down, and they're basically trying to reset the whole financial system, right? Well, something like that is much more probable in a centralized financial system where everything's being stored on centralized databases and controlled by centralized entities. That is the very nature of blockchain technology and why it's so important, because ultimately, you can't shut it down in one easy charge. You've got to really take over the entire network in one way, shape, or form. And the only real weakness to a lot of these blockchain technologies right now is quantum computing, because through quantum computing, they're able to crack these ciphers and these encryption methods, these algorithms, fairly easily if the technology isn't quantum proof. I don't know of any that's 100% quantum proof yet. And so a lot of them are working on it, and they have methods that they're looking to present to their blockchains as updates to make them more quantum proof. But that's about the only limiting factor right now. And as quantum computing continues to take shape and speed up and be a little more capable with all the little quirks and how that stuff works, well, we could be looking at, I honestly, I think in the grand scale of things, quantum computing is going to be a thing. But I think a lot of the biggest, most prominent blockchains will be quantum proof before quantum computing is a real significant threat. And I feel like we probably got 5 to 10 years before it's even going to start rearing its head into a position of threatening status. So we'll just have to see what happens. Outside of that, Cardano, its throughput is going to be through the roof at some point. I mean, we're waiting for Hydra, which is a big update, and Hydra is ultimately going to enable, I think it's something like 1 million transactions per second. I think I broke it down to 86 billion transactions an hour or a day. Ultimately, if there are 3,000 nodes, each node in the Cardano system can handle 1,000 transactions per second. So if you multiply 1,000 transactions per second by 1,000 nodes, how many seconds there are in a minute, in an hour, in a day, there you get the throughput potential for when Hydra launches on the Cardano blockchain. And there isn't a blockchain in existence, to my knowledge, that can come anywhere close to that kind of blockchain throughput. So that's what I'm currently waiting on to happen. And I mean, that's Cardano. And now you should have at least a fundamental understanding as to first gen, second gen, and third generation without it being too convoluted or too confusing. And I'll leave it at that for now, and I'll see you in the next lecture. All right, ladies and gentlemen, now we're going to discuss what I think is one of the most fundamental things to understand when it comes to crypto investing, and that is market cycles. Because if you don't understand market cycles, you don't know what they mean, you don't know why they're happening, then it's very easy to get scared out of positions. It's very easy to FOMO into positions. To give you an example, when I called the market peak in April of last year, I called it on Twitter, and a lot of people were just mad at me as though I was somehow controlling the market. I only have like 40 something thousand followers on, maybe it's 45, I don't remember, 40 something thousand followers on Twitter. I used to never really use Twitter. Now, when I called the market, a lot of people were thinking I was trying to FUD the market because I wanted to buy in cheaper before we went higher, and everybody has their theory, and none of it was true. I was just basically saying, listen, I think that the market has peaked. We're going down for a while. We're going to head into a bear market, but we're going to head into a second peak. This is going to be a 2-peak market. And I said all of this in the same day, I think within a matter of a couple hours. And I was literally getting on a plane to Puerto Rico when I tweeted this. So I couldn't do anything about it. I had everything locked. I hadn't sold. I couldn't sell. And I finally, once I finally got a little more situated in Puerto Rico, I started setting limit orders. And I ended up getting out of my Cardano position at about $2 after a $3.14 peak. People were losing it. I mean, just getting mad with me, thinking I was somehow the one pushing the market down, which obviously was not the case. So fast forward to now where, we're real deeply set in the bear market. Bitcoin, I think, is broken down into the 15,000 range. Cardano has dropped down to 33 cents. And people are asking me, when are you buying back in? Well, I already started averaging in around 50 cents, even though I suspected we were going to go significantly lower. I don't mind averaging in or out, which is what I generally do as a long-term investor. And because people don't understand the cycles, they don't understand exactly what's coming next. And, when you see the price at 314 and you're not really familiar with the time in between each cycle and what have you, well, you could have started buying in at $1. Maybe you started buying in, maybe you start buying in now or 70 cents or whatever. Not necessarily looking to have an average in or out plan, but basically just looking to go all in at a particular moment. And then when it goes lower, let's say you went in at 75 cents, not really understanding the cycle, thinking, oh, it's going to go up from here, right? It's so much lower. And then it goes down to 50 cents, and then it goes down to 40 cents and down into 30 cents. Well, at what point do you get triggered and say, rather than average down your entry, you just sell at a loss because it's how low is it going to go? I can't afford to lose this money. Well, you only really sell what you sell, or you only lose what you sell at a loss, for one. And the other caveat to that is we basically say you never invest more than you can afford to lose, because if you're investing money you can afford to play with, you're not going to make drastic last-minute emotional decisions based on what's happening. So that being said, we're going to take a look at the market cycles, and I'm going to explain some things. So for one, you can see here the basic cycle of a market. Okay, you start down below, and you can say, all right, well, we've got hope. Well, at the very bottom, this rally will fall like the others as the price starts to really go higher. This is after a depression, right? So stemming from the last cycle. So you can see here. It's a pretty big mess. So we're going to try and expand this a little bit so you can see it a little better. But you can see we have disbelief. Then you have hope. Oh, maybe things are going to go better. Maybe things are getting better. And then you have optimism. This rally is real. We're really moving, right? And then you go into belief and thrill, and then at the peak you get euphoria, and that's where everybody's so pumped up and they can't possibly fathom the idea of the price going down, which is exactly where I called the peak of the last market. And everybody was so mad at me because they're like, "Oh, you're fudding, Crow. You're fudding. There's no way." And then boom, we start to crash. Like overnight, we lost a significant sum of money in the market cap. And then, we get some up and down activity, and then you have complacency. Then anxiety. Anxiety is exactly where I was. Even though I understand and I know, I still feel these things. I still get anxious. What if I'm wrong? What if something big happens to send things the other way? So forth and so on. You have denial. And then all the way down at the bottom here, you have capitulation. Basically, like, the sky is falling. It's the end of the world. I'm done. I'm spent. I can't take it anymore. And then you have you start to move up, and you get into panic. And how long is this going to take? And what's happening next? Then you get angry because you've spent all this time riding these market cycles, investing, accumulating, doing what you think, but you just don't understand the cycles, and you got caught up and you bought something at the peak with all the FOMO and the marketing just hitting you right in the face, and you bought in at the highs, and you basically just watched everything come crashing down, and you're pissed. You're angry about it now. And then that anger, ultimately, you get jostled around a little bit until you end up in depression and then disbelief, and then you start the next market. I basically call it chasing the dragon of crypto. You're chasing those new highs, which is why if you look at YouTubers on crypto, you can see the hopium videos always get the most views. You know, the people who are unrealistic typically do much better on YouTube, because it's the sentiment everybody wants to hear. It can't rain all the time. It's not going to rain much longer. We're almost at the end of this. We're almost there. We're almost there. But it never really seems to come until it does. And by that point, everybody's already capitulated. They're done. They're spent. You know, everybody's YouTube numbers have dropped. So what you're looking at now is the Bitcoin halving chart. You can see here, you've got the first halving, you've got the second halving, third halving, okay? Because this halving happens every 4 years, and it has since 2009 when Bitcoin was first launched. So every 4 years, what happens is the mining yield gets cut in half, okay? So, you know, if all of the miners in the world are mining up 100 Bitcoin a day, you have a halving. Well, now that's dropped to 50 Bitcoin a day. And then in the second halving, 25 Bitcoin a day, and so forth and so on. It'll keep getting cut in half. I think the final Bitcoin is supposed to be mined up at like 2042 or something. Okay. And if it keeps getting cut in half, well, is it ever really mined up? Because it's fractional by like 100 million or something. So, but at the same time, once the mining is the minting of new blocks. But by the time that the mining hash rate, everything has gone so exponentially high that minting new blocks isn't necessarily a thing, because in 2040, there aren't that many blocks. It's all going to be about getting those fractions of transaction fees and things, right? So it's going to be a little bit different. But we're still in its infancy. Even though we're now heading into, 4 halvings. It's still very much in its infancy. And the next Bitcoin halving isn't going to be until 2024. So we still have like a good year and a half until the next halving. Well, what happens at the halving is, price changes quite a bit. And I'm going to show you ultimately what I see is going to happen. So we're going to open this up here. And I'm going to show you my chart. All right, so this is my Bitcoin weekly chart right now. And you can see how, we had the one peak and then the second peak, and then we continued working our way down. And here we are right here. Now, you're going to see, what I called the second peak. A lot of people are like, how did you know that? How could you possibly have known that? Well, I do a lot of experimenting, and I like to do a lot of different things. So I was actually comparing the NASDAQ 2003 on, and I took the peak of the NASDAQ and I did a bars pattern, and I threw it over my chart in Bitcoin on a weekly candle. And lo and behold, it lined up pretty accurately all the way back here. And so I saw a 2-peak cycle in the NASDAQ, and I'm like, and everything else lined up. So then I just went ahead and did a bars pattern from the peak at the end. And then I'm like, okay, how is the bear market going to go? And so far it's been pretty accurate there too. And there's a whole theory that I have on that, but that's another video or YouTube video. But anyway, here we are right now in this weekly candle. We've been dropping down to new lows. I have explained that I could see us wicking down to $10,690 at the bottom, and at which point we will have dropped 85% in Bitcoin's value from the second peak of the market. Technically, I think we could actually hit 9,600. Okay. at which point we'll probably climb back up. Now, if you're looking at this blue line right here, this is the proposed halving date in April of 2024. So what generally happens is I expect us to see potentially not new highs, but we will have climbed back a decent amount towards the previous high somewhere within this channel. And then we'll cross into the halving. We're likely to get a little bit of a dip post halving, which is pretty common. And then we start heading off into our next bull market. Okay. And we have seen this time and time and time again. This is what happened at the last halving. So if you look all the way back here, this is where I was planning my convention when Bitcoin was at $4,000, trying to tell everybody the same thing I'm telling them now. Listen, we've got another opportunity from the 2017 market where Bitcoin topped out at around 20,000, came all the way down to 4. And the sentiment was Bitcoin will never see 8,000 again, right? And because people read these headlines and they think that's the case, they don't look at the overall, like, what's happening? Why is this happening? At the time, JP Morgan, all these major institutions, these banking institutions, funds, all these people were basically building their vehicles for, investing into crypto, establishing their own order desks and all sorts of things. And they were flooding the market, trying to keep the price down. And a lot of people that were coming from traditional markets believed it. And so the sentiment was, oh, Bitcoin's never going to see 8,000 again. And then suddenly, when JP Morgan and Diamond and all these guys, Goldman Sachs, all these groups, they got all their vehicles in place, their order desks, everything, all of a sudden, Bitcoin to new highs. The whole sentiment in the press changed. And then we saw the price start to rise, right? Because people are starting to come around. And then we went sideways for quite a while until the halving. And this is the same thing that happened in the previous halving cycles, but I have to zoom in, but it's all very, very similar. Okay. So that is what a halving cycle is. That is what these market cycles are all about. And the thing of it is, these cycles genuinely, it dictates everything going on in the crypto space. Okay. And at some point, some of these things actually play a role in the traditional financial markets as well. You can see confluence in what's happening in the Bitcoin price and then traditional stocks. Now, this is the Bitcoin difficulty chart. And, everybody talks about the having this, having that. And what nobody ever really mentions is that it goes beyond just the every 4-year mining yields cut in half. It goes beyond that because the difficulty in Bitcoin consistently rises every month. This is 2016 all the way back here. And you can see the difficulty in mining Bitcoin has continued to climb. We had some substantial dips. This was August of 2021. Okay. So May, this is around the peak when everything crashes. You had miners selling up. They were using old mining equipment. A lot of big mining farms were liquidating their old mining equipment. Hash rates dropped. But as the number of miners throughout the world running these nodes and so forth continue to grow, difficulty goes up because the algorithm is structured that way. So the more people there are trying to get a piece of the Bitcoin pie, the more difficult it is to get that piece. Okay, so it's brilliant, really. It's absolutely brilliant. But ultimately, this plays a significant role in the price action as well. So that's ultimately it in a nutshell. I mean, the mining or the halving system, the market cycles, this has been an every 4-year occurrence. Me calling the peak and calling the bottom before that's not because I'm psychic or I'm some wizard trader. It's just understanding what's happening. Now, as we move forward, and I'm going to leave you with this, as traditional markets continue to, what I believe, I believe regulation is going to continue, flowing into the crypto space. And I ultimately think that traditional stocks are going to be tokenized. We're going to see them either in the form of NFTs, security tokens, traded on US regulated exchanges, probably something like Coinbase. Now, when this stuff comes to fruition, maybe I'll be a prophet at that point. But that's where I think we're going. Not only that, but I believe that regulations are probably going to push out a lot of the stable tokens in the market, like USD Tether and some of these others, in favor of like the CBDC tokens, which I'll get into in another lecture later. There are a lot of changes happening, and ultimately I see a merger of the crypto market and the traditional stock markets, and they all become one thing. And I believe that a lot of that is going to happen and stem from the crypto regulation that's going to be happening. That we already have some commodity securities, what's what. Nobody really knows 100%. It's always kind of in question. But once that gets boiled down and we figure that out, well, then I think the paradigm is going to change in crypto quite a bit. And I think that when that happens, the Bitcoin halving cycle may very well not play as significant a role in what happens in the crypto markets, because there are so many other variables to things at that point, when it's going to be more based on macroeconomic, global economic systems and situations, instead of just, here's a mining algorithm that happens every 4 years, everything gets cut, the supply gets cut in half while demand goes higher. So hopefully that makes sense to you, and that should hopefully put things into a little bit of perspective as we continue to move forward throughout this course. I'll see you soon. So here we are. You're just now starting to dive into the cryptocurrency journey, and everything sounds intimidating and crazy, and there's so much to it. But before we get too deep into a lot of this stuff, where we're going to make things much more simplistic and easier to understand and wrap your head around, the one key thing that I want to start addressing is security. And that's one of the reasons why I'm putting this up towards the top, because I think that there are certain practices that you're going to need to start getting used to as you continue to move forward in your cryptocurrency journey. Believe me when I tell you, the easier it is for you to access anything, the easier it is for a hacker or an intruder to do the same. And so you're going to have to adopt, especially if you have large sums of crypto that you're planning on investing in or holding or accumulating, whatever, you're going to really need to adopt these. And some of them are going to suck. I'm telling you now, some of them aren't going to be exactly fun. The things that I have had to do to keep myself secure after 2 hacks, I go crazy. And I tell you right now, I'm sure there are plenty of things in the world that can give you a really terrible sunken feeling of just complete invasion. But for me personally, one of the most terrible feelings was when I realized my computer was hacked and a Russian hacker had access to my account or my computer all night, and held my YouTube channel hostage, was on my Twitter account tweeting at me. I'm telling you right now, it was insane. Luckily for me, because of some of the things that I've done in this, they didn't get anything of value, and they did shut down my YouTube account. But there are so many things that I've adopted since then that I'm sharing with you here. I am telling you right now, as the first video of this segment, the first video of this list of videos, do not ignore these. Do not ignore these. I don't care if they're time consuming. I don't care if they make your investments and the things that you do a real pain in the butt. Do not ignore these. Okay. Hopefully I'm making myself abundantly clear. The very first thing that we're going to talk about right now are your passwords. Quite simply, you don't save them in your browser. And that is something that, well, let me put it to you this way. You don't want to save passwords for anything of value or anything that would cause you harm should it get out. And that's one of the key things. You don't want to save useful or valuable passwords in your browser, because there are a lot of reasons for this. Number one, let's say you're clicking around in your email, somebody sends you some email and it says, hey, check this out, I thought you might like this. You click it, boom, you might have just opened up a port giving somebody access to Sub7, your account. You don't even need to know what that means, other than they now have access to your entire computer. You never know when clicking something is going to give somebody access. And in addition to passwords and not saving them in your browser, there are a few other things that I want you to consider. I'm gonna supplement this list. 8 characters minimum. Okay, I don't think I've ever used any less than 12. And the reason for this is the higher the number of characters you use in a password, with the more variety in the password units, the more difficult it is to brute hack something. Okay. There are a lot of software packages out there for brute forcing passwords. If somebody wants an account access of yours enough, they can sometimes get it. It depends on what the account is, where it is, what kind of server it's on, what the website is, what the website security is, so forth and so on. But more often than not, you're going to find yourself, if you have a website that you own or whatever, there are a lot of methods from which people are able to brute force passwords. The number of characters in your password magnify the number of attempts into the millions when you start getting into a 12-unit password or more. So typically, and I always use letters, numbers, different symbols, and they're nonsensical. Okay, so and oftentimes, even if you're using a password and an opportunity comes up where you're told, hey, we can create a random password for you, it looks like a lot of gobbledygook. Often, that's probably a pretty good one, but you want to make sure that it has no less than 8 characters. Keep away from dictionary words. That's a really big one, because a lot of brute force attempts will ultimately use words that are known. Okay, easy words. If you've ever seen the movie Hackers I think it was the 80s, it was one of my favorite movies. God, admin, stuff like that. The different passwords that people use are silly. The names of your children, your maiden name, just different things that are tied to you personally. Don't do it. Just don't do it. Now, you're going to ask yourself, oh, Crow, so what if I do all this? I have a 15-string password and it's a bunch of numbers and special. If I can't save it on my browser, what do? You get a ledger book, and preferably a hardbound, even a lockable ledger book. And not only that, but I would suggest making 2 copies of it. Keeping one put away, whether it's in a safe deposit box or something like that, as a backup should something happen. But ultimately, you want to be writing your passwords down in a book. Yes, you want to be inputting those passwords every time you log into a financial account. You just don't want them saved in your browser. Well, why else don't you? Well, because another tip here is, let's say you've got 5 websites, okay, that you access frequently. You're using the same password in every one of these websites, okay? Maybe one of them saved in your browser because it's really important, but the others aren't. Well, you still messed up, because not only should you be using a completely different password for every major account you utilize, you're not saving them in your browser, but you're writing them in your book. Why? Well, because if you use the same password, let's say I created a big long password for my financial account, but then I used that same password on some silly, could be anything, any kind of other website. Maybe you use it on a website where you buy printing or t-shirts or whatever. If that website gets hacked, and the database of user data, which we see all the time, gets hacked, now they know your username is attached to this password on this website. What would you as a hacker likely try next? Other websites. You can do email searches. You can go to other websites. Depending on the kind of data that is stored on the database that they hacked, it could say, well, you like to use this website and these are your other interests. And then they can start looking at other websites, some of the most common websites, like maybe your Facebook account. All they have to do is plug in an email address and in that password and see if it accesses some sort of social media account, maybe your Twitter. So that's why you never use the same password more than once. Okay, so these are some pretty key things. No family names which, a lot of people like to use their kids' names and things like that. You don't want to do that. Use special characters in words. Like this is an example of what they use Charlie. So they're trying to spell Charlie. They use, like a numeric code, a number 4 instead of an A, exclamation mark instead of an L, a number 3 instead of an E. Now, here's the thing, though. Hacker, this is all leet speak. This is pretty much... Hackers created this, okay, as a fun way of talking to each other on like IRC chats and things. You know what I mean? This is all leet speak. This is hacker leet speak. So they're obviously very well aware of these tactics and things, but it could be an A or a 4. And you're basically increasing the number of variables that would be necessary to solve in ultimately a string that is unguessable. So, and the longer a hacker has to spend time trying to brute force your password, the sooner it's likely they're going to give up. They're not going to, especially if it's just some random thing. They don't know if you've got anything. They're just curious. Using passphrases, not passwords. So oftentimes people will use like a string of like I ate brown cheese, number, symbol, whatever, right? And that can sometimes be just as difficult to crack as something completely random, but ultimately it's more about the number of strings that you're using, a number of units, a number of letters and symbols and things. Using numbers to finish words, which we've already gone over, condensing favorite sayings, removing the vowels and adding numbers. So basically, in a nutshell, it's all about just creating as complex and unguessable password for anyone that might know you, anyone that might see you, have any idea what your interests might be, so forth and so on. You're not saving them in your browsers. You're writing them down in a ledger book. You're creating a new password for every single website or account you have. Period. End of story. On to the next lesson. Now, I'm going to go over this little gizmo here because it's pretty important. It's one that I use. I use multiple versions because you'll realize in my little lectures here that I decentralize pretty much everything I do. Being a YouTuber, being a public figure in the crypto space, I'm obviously a target. I obviously go to insane lengths for my security, both throughout my house, through all of my computers. I decentralize everything. So you may not have to go as crazy as I do. However, it's better safe than sorry, I've learned. And a YubiKey is actually pretty simple. It's a little device that you'll plug into your USB port, and you push the little button. And that's it. That's all it is. In the grand scheme of things, there's an encrypted system inside these keys, and there's a receiving end and an insertion end. And basically what happens is if you're on a website and it says, would you like to use a hardware key? Then it will send an encrypted code to your hardware key. You hit that button, the hardware button, and it creates a lock. And then from then on, if you do not have that hardware key, so let's say somebody hacked your username, your password, they hacked everything, but they don't have that YubiKey, they're not getting access to that account. And I favor this to the max, really, because I actually really like using these. And you're going to learn in the next lecture that this is far superior, in my opinion, to SMS. But I would ultimately use this in association with like a Google two-factor at the same time. But if I had to choose one or the other, I would likely be using a YubiKey. And they're all you can get they're different models, different prices. I'm pretty sure you can get some of these for as low as $25. The biggest thing is you don't want to lose these. So I would encourage you, should you get one and you start using one, to make sure you know exactly where they are. But you can see Yubico is a really big YubiKey company, and you can get these pretty much anywhere. You can get those directly from the website. You can get those from Amazon. I will say, though, as a side note, anytime you buy any kind of crypto related hardware from Amazon or any other website, but primarily Amazon, you want to make sure that you're buying it directly from the manufacturer, not a third party. That is especially true with crypto wallets, hardware wallets, because the same as, you see people talk about in the gaming world, people buy games and they play them and they rewrap them and, try to resell them. Similar things happen in the crypto space where companies will buy a bulk number of these hardware wallets. They'll take these hardware wallets in, they will crack them, they will input malware into these hardware wallets that leaves a back door, okay, that will, once connected to your computer, will send a signal saying, hey, XYZ user just logged in with this tampered with wallet, and boom, they've got access to everything on it, okay? And so always buy directly from a manufacturer, never buy anything. And we'll cover this in a little bit, but ultimately that's a really big thing. And I would say the same goes true with YubiKeys or anything else that's digital, that's focused on security. You want to get it directly from the manufacturer, not from a third party. Okay, so now we're going to talk about two other security measures that you'll likely be choosing from, especially as you're getting access to crypto exchanges and wallets and things of that nature. And that's Google two-factor authenticator and SMS. Now, right off the bat, I'm going to tell you, never use SMS, okay? SMS is a system whereby if you're trying to access your account on an exchange, you'll input your cell phone number and it will send you a PIN code to your cell phone, okay, like a little text message, an SMS message, and you'll have to input that PIN code into the exchange to open your account. Why is this a problem? Because it sounds pretty good, but it's not. Because what is known to happen, and has happened to me, is you can get what is called SIM ported. And what happens is, whether there's somebody that works on the inside of a phone company or not, okay, I don't know exactly how they're pulling these off, but they're still doing them. You can look up Michael Turpin sues AT&T. You can Google that, and that'll give you an idea, because this happened to him. It happened to me shortly after. And I did a whole video on it. Where I recorded the customer support representatives telling me that I was basically crazy for thinking it was possible, until I finally got somebody on the phone who said, yeah, this happened this morning, and so forth and so on, and obviously didn't get the memo to keep hush hush. So I recorded the whole thing, turned it into a YouTube video that's still up today. You can hear my panic and my emotion in that, let's just say. So this is one of the reasons why I'm spending more time on security with you than others might, because I know firsthand how big of a deal all this stuff is, and I'm not telling you this stuff to fill up time. Let's put it that way. So anyway, SMS is, if somebody were to SIM port you, they're ultimately calling the cell phone company and they're saying, hey, I want to change my phone number. I want to put my phone number onto another phone I just got. And so what happens is they transfer the phone number from your SIM card on your phone to another SIM card on their phone. And then once that's complete, they can go to your exchange account and they can log in and do all sorts of things. And then when it sends that SMS code, well, now it's going to your phone number on their phone. Ping, ping, ping. They put it in and they get access to your account. You don't want that. What you want is a Google Authenticator instead. So when you're given the option, I would highly encourage somebody to use Google Authenticator. You can get it on Android or iOS. And ultimately what happens is, it's very, very easy to use. I thought about turning this into a tutorial. I can, if you guys need me to, just let me know in a comment or something. But ultimately, you download the app. And when you're in the exchange and it says, would you like to set up Google two-factor? You click yes, and it'll give you a QR code. And you'll open up the Google Authenticator app and you'll click this little box down here. So you can see the little X and the pencil over here. You'll click that little X and it'll open up your camera. And with your camera, you're ultimately going to basically it's automatically going to focus itself on that QR code, and then boom, you're going to see a number pop up. And that number, like the 163612, that is going to be your code. Well, what happens is that changes like every 10 seconds. So if you do not have that Authenticator app, you cannot access that account. And so, because it changes constantly. All right. I remember the first time I had seen something like this was when a relative, or actually it was a friend of mine, worked for Procter & Gamble, and they had these little keychains that basically did the same thing if they want access to whatever they had access to. And so that was a pretty big deal. And so that is the number one thing. Now, the other thing that I'm going to tell you is that you want to make backups of these QR codes. Now, this is something I never see, and this is something that I've always done, is especially if you're going to be trading large sums. Maybe this is a little extreme for some people, but ultimately you want to write down the backups that you're given, because you're going to get a little backup key. You want to write that down. Make sure you label what website it's for, okay? And then I always take a picture of that QR code, and I take a picture of that QR code on a device like an iPod that never touches the internet ever, and it sits in a safety deposit box, and I don't touch it, and that's it. It's a backup for all accounts in case something should go wrong, because sometimes what will happen is your phone or your device, if your battery starts to wear down or it starts to get a little weird, you might realize that your Authenticator app doesn't work, and you're like, oh my gosh, this doesn't work anymore. What's going on? Well, it's more likely that your battery is running low and the time clock in your phone or your device is not keeping up to date properly, at which point you need to resync your time and then try your Google Authenticator code again, and then it should work. Nobody ever talks about these things. It drives me insane. I've had to learn all this stuff myself the hard way. So hopefully this helps you moving in the future. But yeah, Google Authenticator is primo, and so is having a YubiKey. I would always stay away from SMS because it never seems to create anything but trouble. And as a matter of fact, a lot of exchanges are starting to discontinue use of SMS for that same reason. Okay, so now we're going to get into something called email spoofing, which you're going to run into a lot in crypto. Not to scare you away, but as long as you're prepared and you know what you're looking for and you know what to expect, it shouldn't affect you much. But ultimately, email spoofing is when somebody sends you an email. Let's say your grandmother sends you an email, or your grandfather, or somebody you know, and they email you all the time. But out of nowhere, they send you this really weird email. And you're like, this doesn't make any sense. Why would they send me this? It looks like it came from them. It is from their email address, but they didn't send it. Somehow, they knew that you were expecting information from this person, website, wherever, and they made some really odd request of you, or they're demanding more information from you. That's basically spoofing, because what happens is, I had a period of time, I don't think it happens quite as much anymore that I'm aware of, but I used to get reports all the time from fans and things on YouTube that would basically say, hey, you just sent me this email, what is this? And I'm like, I didn't send you an email. And I get emails all the time from different exchanges I don't even use, basically saying they need more information, or they need my ID, or they need proof of this, or they need that. Click this link. You don't click those links. I never click anything in an email that I did not immediately request, period. I don't click links in email. And as a matter of fact, I use what's called a crypto wall, which I don't have it slated, but maybe I will do a brief video on it. A crypto wall, I even have coupon codes for people, but it's kind of pricey. It's a couple grand, but it is a hardware firewall, and it catches a lot of malware, a lot of things that might get emailed to me. They don't even get through. So I don't see a lot of that stuff, but I still do get links sometimes, which is all the reason why I don't click them. But ultimately, a spoofed email is an email that's made to look like it's coming from somebody or something you trust, that is it's a cause for action. It's basically like, hey, we need information from you, and we need you to click this link to provide it. And sometimes they can be even fearful, where it'll do this or else, or you're going to lose your account, or whatever it is. But they look like a regular email, and often they're using corporate logos, all sorts of things. Response required. You must do this, and oftentimes it's bogus. And so if you get an email like this from a crypto exchange, or basically anyone telling you that they need XYZ information from you and to click a particular link, generally, if you roll over the link, you can tell that it's not going to that main website. There's always, it's not something .paypal.com. It's some other random ghosted website. A ghost site is basically like, they take a website and then they use like a URL shortener, okay, so that you can't see exactly where that link is going. 99.99% of the time, these links are going to some form of malware that is they're trying to get access to something. And oftentimes they're very legitimate looking emails. But what's funny is, I used to get responses. I used to get emails all the time saying, hey, I sent you this information. What do I do now? Or whatever. And I'm like, I didn't send you an email. What are you talking about? Oh, and then they'll forward me the email. I'm like, somebody is spoofing my email account. And as a matter of fact, I think what I did with Google back in the day stopped a lot of the spoofing, because there are ways that you can stop people from spoofing your email. I'm not sure if that worked or not. Maybe it's a coincidence. It's been years since I've had a report. But yeah, this is something you want to be very, very aware of. And it happens constantly, almost daily, especially if if you have a name in crypto, unfortunately, like I do, you're the target for a lot of this kind of stuff, because if people on the outside know you hold crypto, you're going to get hit with all kinds of random craziness. And you have to look at everything as though somebody's trying to take your money, somebody's trying to access your accounts, somebody's trying to do you harm, period. And I hate to say it that way, because cryptocurrency is such an amazing technology, and we're in such an amazing place right now. But that's the reason why it's so popular for hackers and scammers and just dirtballs alike, because there's so much money being made by everyone. And if these people can get it in a way they know without having to put in the work, like any other industry, they're going to do it, and they're going to continue trying. So yeah, be on the lookout for email spoofing, and know if you reply to somebody that's email spoofing you, you're probably going to get an error, or it's going to bounce, because it's not a real email. It's not actually coming from that company. They just basically put that from address into the from the sender panel. That's it. Typically that's all it really takes. But if you reply to it, they're not going to get it. They don't care that you reply. They care that you do what you're told to do in that particular email. So if you have a question, call the company. Not using any of the information, go to their website and call them. If it's something very important, hey, I got this email. This is what it says. Are you really asking me to do this? They're probably going to tell you, no, somebody is spoofing our email account. We don't send emails with stuff like that. So just be on the lookout for email spoofing. All right, so now we're going to talk about airdrops. Now, airdrops can sometimes be like money falling from the sky, but nothing's ever truly free. And with airdrops, while enticing and while sometimes fun and potentially legitimate, anytime I see the word airdrop for something, I run. Especially if there's a call to action to participate in that particular airdrop, and I'll explain why. An airdrop is ultimately when a cryptocurrency company maybe launches a sidechain token. Maybe it's necessary for use in their new ecosystem or what have you. And they're typically dropped to user account wallets for free. Typically based on a ratio of the number of tokens you own from their previous project or whatever their primary token is. And you'll see this. I don't really see airdrops as much anymore, but they are still a very, very much a part of the ecosystem. However, what has happened is that a lot of companies will go out and they'll launch these tokens, and then they'll start preparing and releasing information about a side chain token, and that they're going to do an airdrop. Well, what typically happens, and it doesn't have to happen this way, but fraudulent companies will then go and try and beat them to the punch and take advantage of that FOMO. They'll take advantage of the news releases, and they'll launch a fake company, and they'll launch a fake Twitter account, and they'll do all these things. And then they'll use bots to bump up the volume of the number of followers to make it more legitimate. And because it's virtually impossible, well, it has been virtually impossible to get verified on things like Twitter unless you meet a certain little limited criteria. It's not about protecting anybody. I can tell you that. I have impersonators all over Twitter, Facebook, everywhere. Nobody seems to care. And so because it's so difficult to get verified, these impersonators and fraudsters are able to capitalize on that. And they do, to the tune of tens of millions, if not more. And what they'll ultimately do is they'll put out something on Twitter or email or spoofing or whatever, and they'll say, hey, we're going to be doing our airdrop in 10 minutes. If you want your tokens, click this link. And then you go and you click that link, and they'll say, okay, in order to receive your tokens, we need your seed phrase. What do you do with the seed phrase, folks? Nothing. You do nothing. You never share your seed phrase. If you're following instruction to this point, you're taking that seed phrase, you're carving it into a metal slate, and you're throwing it in a safe deposit box or a safe in your house, or you're burying it somewhere in your yard. You're not keeping it readily available to throw at every airdrop. Because then what happens when somebody has your seed phrase? They wipe out your entire wallet. They can wipe out your entire wallet in seconds. So, and we see evidence of this as this is from May of 2022. Fraudulent Luna airdrop spotted a day before Luna 2.0 launch. And it's ultimately what they did. They basically said, hey, send us your information. We're going to make sure you're a part of this airdrop. We're going to send you your free tokens. And different ventures do it in different ways. Sometimes it could be a matter of just a link. You click a link, it opens up your wallet. They can take stuff out of it. Sometimes they want your seed phrase or your seed key. They'll say upload, like if you're using Metamask and maybe you have an actual JSON file. They'll say upload your JSON file to receive your airdrop. All of these are methods of unlocking your wallet. Don't do them ever. I don't care how good anything sounds, anything it seems. I don't care if you think you're going to make $1 million overnight because you bought, $100,000 worth of a particular token, and you see a big airdrop coming and you want to make sure you get your stake. Don't do it. Just don't do it. Okay. That's all there really is to this. Because if you already own those tokens and they're sitting on a wallet, a legitimate airdrop doesn't need anything else from you, because they can read the wallet addresses already that contain tokens. So if you have your tokens sitting on a wallet already, if it's an ERC based, like an Ethereum based wallet, or it's like a Metamask wallet or something like that, which I only ever use for play money. I never use for significant storage of anything. But if you're using one of those wallets, you own these coins. You don't have to do anything else. You'll just see the coins pop up. However, there's also something that I want to point out. You know what? Maybe I'll do that in the next lecture. But ultimately, you're going to see a lot of crap coins pop up on your wallet because of this. Because it doesn't take much to know this user has X amount of tokens on this wallet. Because they wallet scan on different blockchain explorers. So stay away from those tokens. Because there are cases where people have opened or clicked or tried to use tokens that have just magically appeared on their wallet, and somehow it created a backdoor to that wallet. So don't do it. Okay, but I'll probably cover that in a future video. All right, so now we're going to talk about cryptocurrency wallets. Now, this is an important topic because ultimately this is exactly what you're going to use to store your cryptocurrencies. And there are a lot of different variables associated with crypto wallets. The two prime categories of a cryptocurrency wallet are hot wallets or cold wallets. Now, the difference between the two is a hot wallet can be basically any wallet that is regularly connected to the internet, such as a Metamask for like Ethereum, a NAMI wallet for Cardano. And there are, every blockchain typically has its own branded hot wallet. A hot wallet is generally something that it's stored in your web browser. It's something you access, you kind of download as an extension to Chrome, or what I prefer to use, Brave, and any other browser for that matter. But they're ultimately connected to the internet all the time. And ultimately, they're far more dangerous to use than a cold wallet. A cold wallet is generally a hardware wallet. Okay. So, a hardware wallet, it looks like something like this. You've got different ledgers, you've got Trezor, different ones. And I'm going to go over those in the next lectures. But ultimately, what I also tell people is you can download, let's say you're wanting to get active in Ethereum blockchain trading or what have you. You can download Metamask, and then you can ultimately keep your keys completely separate. So, you can download like your JSON file or other files associated with Metamask, or just your seed phrase. And you can do that and log out of the wallet entirely, and it's still all there, right? Or if you have your Metamask, if you want to use a hot wallet on a computer, but you don't want it to be quote unquote a hot wallet, I would advise using a computer that not necessarily an old junky computer, because you want it to be functional. You don't want to make mistakes because the computer glitched or whatever. But ultimately, to use a computer that you don't use for anything else, you don't use it for internet browsing, you don't use it to be clicking around in emails or any of that, and then keep that computer disconnected from the internet, ultimately turning that hot wallet into more of a cold wallet. And that's just something that, I do myself with, different play wallets and things. And so, yeah, I mean, that's primarily the difference is, one is connected to the internet quite a bit, and then, or if not 24/7, which I don't recommend for anybody, especially on a computer you use on a regular, and then a hardware wallet, such as a little device that keeps track of your keys and so forth. Okay, so now we're going to talk about hot wallets specifically, and we're going to give some examples of different hot wallets that you may or may not want to try out. There are some that I've found to be better than others. Some are more multifunctional than others. Some have built-in token swaps. Some are multi-chain wallets that, basically they support a variety of different blockchains, and are, there's a lot. So we're gonna start with three primary ones for me, ultimately, that I've kind of grown to like over the years. The very first one, actually, let's get to the easiest one, which is MetaMask. Now, I'm gonna say up front, I don't particularly like MetaMask, though it is easiest to use. It's one of the easier wallets. It is a browser-based hot wallet. There's a lot of functionality to it, but since Ethereum 2.0 merged, there's some other issues associated with it that I won't necessarily get in right now. That's not vital. But ultimately, it's a plugin that you download for your browser, and then it will operate from within your browser. And I will show you setting those up. I will show you setting these up in individual videos, but for now, I'm just going to go over what's available. There are a lot of different platforms like DeFi applications. There are a lot of different things that ultimately plug into your MetaMask with your permission. You have to click approve on these transactions and things. However, there's a lot of scammy stuff associated with these wallets, not from the wallets themselves, but with the way scammers and hackers can get access to these hot wallets. Because by clicking some different links that you might find either through phishing or otherwise, it could potentially open up ports and vulnerabilities in some of these things. And typically, MetaMask being one of the biggest ERC20 wallets out there, especially the biggest hot wallet out there, they're always working on patching things. Another thing that you want to look for when you're looking for these wallets is that you want to make sure you're getting the right address, and you never, ever, ever want to click ads. Like if you Google, crypto hot wallet and you see an ad for MetaMask, you don't click those, because generally those are hack. Those are, and Google, Facebook, YouTube, they're all super slow at removing bad stuff. I mean, I should say, I mean, if it's political, they'll get rid of it immediately. But if it's like a hack, or if it's, you know, something that's nefarious and affecting a lot of users, tens of thousands of users, and stealing their money, it could be a while until anybody lifts a finger. I don't know why it's the case, but we've found that. That's why they just stopped. At one point, they started making it really difficult to even buy advertising, and that's a whole other topic. But to be on point here, Metamask is a good wallet, but it is definitely something you want to be very careful when you use. And that is primarily for Ethereum. And there are other blockchains like Binance Smart Chain and things like that that will function on MetaMask, but it gets a little more technical. And that's not something we're going to go over right now because I don't see you using any of that in the short term. Now, this is NAMI wallet, which is for Cardano specifically. It's very, very similar to MetaMask, but it's for the Cardano blockchain and the Cardano ecosystem. I use NAMI for like play funds and things that I'm experimenting with. Definitely not my main wallet at all. I won't even say everything that I do for the main bulk of my stuff, but it's definitely not NAMI. But it is a good wallet, and it makes things easy, and it basically functions in very much the same way as MetaMask. Now, for you, I would probably guess that Exodus may very well be one of the easiest wallets with the most functionality, and one that supports multiple blockchains. So manage and exchange 255 plus cryptos and NFTs on your web browser, mobile desktop, and hardware wallets. Get Exodus now. There's so much functionality associated with Exodus. It is absolutely a beautiful interface. It is probably my favorite multi-chain hot wallet out there. And again, if you were using something like Exodus and you put it on a computer that's not connected 24/7 to the internet, then it can act kind of like a cold storage wallet. You just don't want to be putting these wallets on any computer you're actively, regularly using, because vulnerabilities can pop up, and you don't want to, you don't want to find out later that you made a boo-boo somewhere, and the next time you check your wallets, they've all been drained and you're not sure why. That does happen. Okay. So be completely warned here. But this functions Binance Smart Chain, Cardano, I mean, a lot, Stellar Lumens, Ethereum, Bitcoin, Monero for privacy coins. I mean, basically the biggest projects out there will function with Exodus. I would probably suggest setting up your Exodus wallet before much else. That way you have something that's easy to understand with a really easy to use interface. And because of how easy the user interface is to work with, it'll start helping you make sense of some of the lesser pretty or user intuitive wallets out there, because you'll have a better understanding as to what's what. That's just my humble opinion. But you can also download this on a mobile phone. There's a browser extension. Basically everything a lot of these other wallets have, you can do with Exodus as well. Just make sure you back up your seed phrases for everything that you do. Make sure you keep them safe. If you're writing stuff down, don't keep anything wet or liquid around any of it. And then you should be pretty good. But these are the three main ones. Now, there are other wallets that are, you can look up top lists and things like that for some of these wallets. I don't use wallets that I do not see have a long history of being successful and invulnerable to hacks. So just because somebody says, oh, check out this wallet, this is really cool, it's the latest and greatest, I'm not touching it until it's basically proven itself over time, because I don't want to get in at the front of a new trend or some new wallet and there are a bunch of vulnerabilities that haven't been patched out yet. So be very weary of stuff like that. A lot of hot lists, top list things, you never really know. You definitely always want to be safe. You don't want to take unnecessary risks. So, and one of the other things that I'll leave you with is Coinbase wallet's probably pretty good and potentially secure, but again, it's all tied to an exchange directly, which you don't necessarily want. I always tell people you don't use exchanges as a wallet. You use exchanges like a public restroom. You go in, you do your business, and then you get out. You don't leave anything important there, just what you don't want. So let be that as it may. So yeah, I mean, there are a lot of good opportunities out there. There's a lot of good software, but one tip I would say is check Reddit. If you're an internet sleuth at all, and go to reddit.com, join the community for whatever blockchain you're most interested in getting involved with, or whatever wallet, and look at the feedback. What is the public saying? What's the latest news? What's the latest going on? This is something I would implore you to spend a little time with, and make sure you're downloading something that's safe. You're not just using random links thrown around the internet. You're just using Reddit to maybe get a little understanding as to, what is the current sentiment of the particular wallet you're interested in. And in the next couple lectures, I'm going to show you guys how to actively set up some of these wallets, what steps you need to take, and really just how easy it is. So we'll get to that in just a moment. So one of the aspects of cryptocurrency are the way to acquire new tokens, right? Or to new coins, or whatever you might want to call them. Some do it through mining, through proof of work algorithms like Bitcoin, previously Ethereum. Now Ethereum has moved over to proof of work to try and compete with the latest technology, which is proof of stake in Cardano. And there are other methods for generating tokens, such as a masternode. Now, a masternode project, or a masternode is basically, how do I explain this? It's like a network of nodes or computers operating kind of like wallets, but in order to be applicable to generate a passive yield for a particular cryptocurrency, you have to own a certain amount of the coin to begin with. Okay, and I'll show you what I mean here. So this is a website called masternodes.online. Okay, and this is basically a directory of all of the different masternode projects out there. And I already have this tabbed for the highest minimum worth, because one of the most successful masternodes out there is Dash. Okay. And to launch one of these masternodes to generate a passive yield, it would cost right now $34,198, which is actually really cheap for a Dash masternode, because the lowest I checked last time I was looking at these, it was like $80,000. So it's dropped significantly. And of course, we're in a bear market where the valuations of everything has gone down substantially. But ultimately, that $34,000 is the cost to acquire 1,000 Dash tokens. So basically, this masternode is saying, in order to generate a yield, you need to own 1,000 Dash tokens in order to launch this masternode. And based on the current price of the token, it would cost you about 34 grand. And that can change by the hour, by the minute. It's always different. The standard return on investment is 6.14%, and that's paid out in Dash tokens. Okay. So, and this goes on down the list. Some of them will have higher yield. Like this one showing a 54.29% return on investment. This one is a Sapphire. SAP is showing a 57.58%. Costs you $8,461 to launch one of these, because you need 200,000 tokens. The point being is they're all different. And when you're looking at masternodes, you have to look at certain elements of these to find out whether or not, I mean, it goes even deeper than this, but just if I'm looking down this list, what are some things I'm going to look for right off the bat? So like this one, Rapids, it's a fraction of a penny, but you need 10 million tokens to launch this masternode just to get a 0.02% return. And it's going to cost you almost $17,000 to launch this masternode. There are only 247 of them active right now, I'm guessing, with team and hardcore people. And there's no volume. So there's basically no trading volume. I don't even know where you get these tokens. And that's basically it. So that crosses that right off my list. We can move down the list here. Global Smart Asset, GSA, currently trading at 79 cents. Not sure where. It's showing the volume as $3. And so you need 5,000 of these tokens just to launch this masternode. Here's another one. This is actually one of my favorite masternode projects that I've held, and it's treated me very well in the past. I don't currently hold it, but I will likely dive into another one, and that's Divi Project. And Divi Project, they split up their masternodes based off of your minimum required. So like for this one, it might cost you, wait, where'd it go? Divi Project. Yeah. So Divi Silver, it costs you about $30,450. You need 300,000 tokens to launch this masternode at about 1.90% yield. Market capitalization is around 36 million, which is pretty good. Volume, however, is still a little low at $173,639 a daily trading volume. So, but the tokens are basically a penny a piece. Now, from here, what you might want to do is you want to, these masternodes pay out in their native tokens. So with this, you'd earn Divi tokens. With Dash, you're earning Dash tokens. So you have to understand, and this is going to be different for every one of these masternodes, which of these masternodes might be more worthwhile based off of their use case. So you would want to look into like, well, what does Dash do? What's the point of it? What is Divi Project? What does Divi do? And that's basically a matter of going into the website and trying to understand like more about the project. So this shows like weekly income paid out to all Divi master nodes, monthly, yearly. It gives you all the financial stats. And generally speaking, you're able to go to their website to find guides and tutorials, because setting up each master node is different. There's no one way for everything, right? Every master node is going to have its own specific requirements, its functionality. One of Divi Project's big claims to fame is the fact that it's super easy to set up the master node. But this is all, it's all relative to your technical experience. Master nodes are generally very fruitful, but the question is, what use case does the masternode token actually offer? And will that demand increase over time, ultimately increasing the value of the tokens? So masternodes, in a sense, are kind of like, it's like playing its own market, because a lot of masternodes, when they first launch, the costs are very, very low. Some of these masternodes, it might only cost you $100 to launch one. And then, maybe that $100, that's the cumulative price of having 100,000 of those tokens. So what happens when those 100,000 tokens goes up to $1? Then it becomes $100,000 to launch that same masternode. And so, and at the same time, you're building your computer that you're running the masternode on is basically building another node to this total network of nodes all working together, processing transactions, so forth and so on, doing a lot of different things to improve the security of the network, so forth and so on. That's why you're generating this yield. So ultimately, that's masternodes in a nutshell. The trick is understanding which of these has the potential for real growth. Brand new masternodes, like I said, are generally pretty cheap to get into, but you have no real assurance as to whether or not they're going to go anywhere, if the project's going to go anywhere. And then it becomes more of a token evaluation of the team, of the project itself, the company. How long have they been in operation? What has their price history been like over the last year, 2 years, 5 years? How long have they been around? Have there been any hacks? So that is all a part of doing research in masternodes. But running them can actually be pretty fun, because it is a passive yield. And if you make the right bet on a masternode, Divi, to me, has proven itself pretty successfully over the years. I've met members of the team personally. I've had some of them on my channel in the past. That's not to say that Divi is the end all be all, their primary use case is for remittance, basically the ability to transfer funds from point A to point B internationally with minimal fees. And they're building a lot of relationships in the banking industry and things of that nature to continue to grow their use case and their reach and their expansion. So it's definitely something I would encourage you to look into. I'm not telling you to buy it by any stretch, but if anything, it might give you a good grounding understanding of what a masternode token looks like, and kind of some of the things to expect. Dash has proven itself to be very, very profitable for many people. However, if I remember correctly, in the last peak of the market, I don't think the price even got back to its original all-time high from like 2018. So you might want to look at some of that. So like this is the price in 2018. These Dash tokens were over $1,000. They were $1,200 a piece. And then you see here at the last peak, they only got to $400 a piece. Still pretty significant. So, you know, if you're able to get them at the price they're at now, which is 34 bucks, even if each one of these got to 200 bucks at the peak of the next market, you're probably going to do pretty well. And it's probably fairly likely that it'll get somewhere around there. I'm just guessing. I'm not a big Dash token guru, but when you're talking about a market cap of this size, when you're talking about this kind of trade volume, you know, you're talking almost $60 million a day in trade volume. That's pretty significant. And that also means you're able to get in and get out of that particular token with relative ease without suffering slippage being, you know, if I'm trying to get rid of, you know, $100,000 worth of Dash tokens and the order books say that there's only $20,000 available to either buy or sell at a particular price point, well, to get rid of that whole thousand or $100,000 worth, that price may either go down as I'm selling it or it could go up as I'm buying it. So the lower the volume of a particular asset, the more difficult it is to get in and out at the price you're seeing, you know, on CoinMarketCap or your trading window, your chart window, your trading view, that sort of thing. So keep that in mind. You want projects that have high volume, because without that high volume, you're very likely going to start selling something at 30 cents. And by the time you've liquidated all of it, especially if you're using a market order instead of a limit order, which we're going to go into in other lectures here, then the price is likely going to drop on you. And that $100,000 worth of tokens, you may have only been able to exit at like $80,000. So, but that's masternodes in a nutshell. It's definitely fun. It's kind of like treasure hunting in a way. And, you know, if you get the right pick, man, you could be generating some pretty significant return on investment. You know, you're talking about like a passive influx of cryptocurrencies. And so it's a matter of picking the right one. Some people just love and swear by masternodes. I've had my fun with them. I like them. But, you know, I don't dabble as much in masternodes nowadays. There you go. All right, ladies and gentlemen, we're going to get down to it. We're going to start setting up our first wallet. We're going to set up our first hot wallet because it's likely going to be what you're going to be trying to use initially anyway. So we're going to set up Metamask, and we're going to set this up in Firefox, because I'm going to guess if you're not already in crypto, you're probably using Firefox above most other browsers. And I personally prefer Brave, but we're going to do it all in Firefox because I'm going to assume that's what you're using. So let's just get right to it. So the first thing we're going to start off with, obviously, is Google, because that's where you're going to find it most likely. And I'm just going to type in Metamask, and hit return. Now from here, you're going to see a lot of links. Okay. Now the very first thing you're going to see is the Metamask link. And this is verified by my technical, like Kaspersky antiviral, and I have others in place, but this is letting me know that this is a verified link. You probably don't have that. Now, if you were to see ads up here, you would not use them. Okay, when you're trying to do anything in crypto, you never, ever, ever click crypto ads, because typically they are malware. It's bad stuff. And there's a whole way that these fraudulent companies, these bad actors in the space ultimately get around some of the, basically they go through ad firms to buy these ads, and they pretend to be very legitimate. The ad firms typically don't care. They're just taking a cut. They set up these accounts in their name, and it skirts by a lot of stuff. Now, you don't see any ads right now, which is probably because I'm pretty sure YouTube, Google, a lot of these companies, they basically nixed all crypto related advertising for that reason. So here we're just going to click Metamask, and then it's going to bring up the Metamask website. All right. So we can, and right off the bat, it recognizes my browser, download for Firefox. So, start exploring blockchain applications in seconds, trusted by over 30 million users worldwide, which is one of the reasons we're setting it up, because it was one of the very first wallets I set up. So I'm going to set it up for you here. So we're going to click that, and then that add-on, we're going to add to Firefox or whatever your browser is. Access your data for all websites. And this is basically asking us, hey, these are the permissions MetaMask needs. Now, access your data for all websites. This is one of those things that I don't particularly prefer. And in Brave browser, you can limit some of this stuff a lot easier. You can go into the MetaMask settings and change some of this stuff after the fact, but I never use Firefox. This is all just for demonstration purposes anyway. So I'm going to say, yeah, go ahead, check whatever you want. Allow this extension to run in. So I got a little pop-up here. You can't see it. For whatever reason, but it's saying, hey, do you want to allow this extension to run in private mode? Sure. Okay. Get recently closed tabs. All right. Now. All right. So now you'll see this little icon up at the top right of the browser. Okay. If I click that, it's going to take me to MetaMask, connecting you to the Ethereum and decentralized web. We're happy to see you. So I'm going to click get started. Help us to improve MetaMask. I say no thanks, because I don't want anything tracking anymore than it has to function. I'm not trying to send data or anything. I tried to do this transaction or that transaction, and it went a little weird. I'm just going to say no thanks on that. So here, if you're new to MetaMask, it says, hey, no, I already have a secret recovery phrase. So if you're setting up an old wallet, but on a new computer or in a new browser, you can import your wallet here by using your secret recovery phrase. We don't have that. We haven't set up the wallet yet. So we're going to say, yes, let's get set up. And we're going to click create a wallet. A new password. So I'm going to create a really simple password just for demonstration purposes. However, I would encourage you to create a password. This is telling you 8 characters minimum. I'm telling you do at least 12 to 15 if at all possible. You want as many characters in your password as possible. And you're not going to save these in your browser. You're going to write them down in a ledger book of some kind that you are going to keep safe forever. And then you're going to make a backup of that you're probably going to lock away. So on that note, I'm going to create a password. All right. So I've created the password. Now I'm going to confirm it. I have read and agreed to the terms of use. I'm going to create this wallet. No, I don't want to save it. Secure your wallet. Before getting started, watch this short video to learn about your secret recovery phrase and how to keep your wallet safe. You should watch that. Okay. I'm going to click next, but you should definitely want to watch that. Now it's going to present your secret recovery phrase. This is the end all be all to your wallet and all assets on this wallet, period. You're going to need this for everything when you want to, let's say you create this wallet and you get rid of the computer, you wipe it clean. You want to make sure you have this password recovery phrase to import it into another computer in the future. If you do not have it and you do not keep this safe, any crypto, Ethereum, anything that you put on this wallet, should you lose that computer or something should happen, you will lose that crypto forever. There's nobody for you to call. There's nobody to say, hey, I just made a boo-boo. I didn't back up my recovery phrase and my computer blew up and I can't access my funds. There's nobody to call to help you. Okay. That's kind of part of blockchain. So I'm going to click here. I'm going to reveal this, and doesn't matter because this is demo. This is going in the trash when I'm done, but I'm going to write these down. Okay. So I've written these down. So now it's asking me to confirm it. So if you didn't write it down, well, you're already messed up, because now you have to put it into the system so that they know that you wrote it down. You kind of like that? I like the double redundancy there, to make sure you're not horsing around. So I'm going to put mine in here, and there's my first word. Now it knows what your words are because it just created them, but now it wants you to put them back in order. Okay. Nobody else sees this. Nobody else has this. This is just for you. So, but now I'm going to make sure I wrote them down, because I wrote them down in order, and I'm going to input them in the order that I wrote them down. And confirm. Congratulations. I now have a new wallet. And there we go. This is my activated, fully ready to work Ethereum wallet. All right. So now you have your MetaMask set up, and you're like, I don't know what to do from here. Okay. It's simple. Basically, to send and receive transactions with your new wallet, you've got some buttons up here. Okay. So you've got your send, and then you actually have your address right here. So let's say so a friend of yours is wanting to send you some Ethereum to get you started, right? And they say, what's your address? Well, when you're in MetaMask, all you got to do is click here, copy to clipboard, and that's it. And so if I were to click send, it's saying what address to send to. I'm just going to copy that address right there. Now it's telling me there's insufficient funds for gas. Now, the reason for this is because there's literally nothing on this wallet yet. So I haven't sent any Ethereum. You have to have Ethereum in the wallet to send transactions, because every transaction you send on the blockchain has a gas fee. And the gas fee fluctuates. It changes all the time. And that's one of the big issues with Ethereum, is that it does change all the time. The higher the number of transactions going through on Ethereum in any given moment, the more expensive it is to send. And the reason for that is because when you're sending a transaction, you can actually increase how much you spend in gas fees to speed up the transaction. And it almost becomes like a throughput auction. Okay. So oftentimes, especially at the peak of a bull market, we end up in a situation where it can cost more in transaction fees to send whatever amount you're actually sending to somebody. So it's a little crazy. So that being said, but that's it. And then you'll put in the amount you're going to send of whatever asset. In this case, it would be Ethereum. You'd punch in, like 2 Ethereum. That's currently worth $2,580. And then you would click next. And that's pretty much it. So, and the same goes for if somebody's trying to send you a transaction, that's your account right there. You're just copying that address, and you can track your activity through here. So every time you send or receive a transaction, it's going to show up in this little activity log. This is going to break down any assets, any cryptocurrencies that you have on that wallet. You can click here if you wanted to buy something, so you can use Coinbase Pay or basically a lot of different on-ramps for crypto, more popping up all the time. But typically what I tell people, especially early on, is you want to use a US-based regulated cryptocurrency exchange as a fiat on-ramp, because those are insured more often than not. So something like a Coinbase or a Kraken or maybe even a Gemini, and those are going to be your primary fiat on-ramps. By that I mean, without any cryptocurrency in your wallet or somebody to send you some from an exchange to get you started, you're not going to be able to do much with the wallet yet. So what I always say is you might want to go to Coinbase, set up your account there. There'll be links in the description, I'm sure, under this video. And when you set up your Coinbase account, you'll be able to add a credit card or a bank account, and then you'll be able to transfer fees. Now, sometimes it could take a week or two, especially for new accounts. for funds to clear before you can make any purchases. So know that. And you know, if you're planning on doing something in the future, making a buy, waiting for the crypto bottom, whatever, you might want to get your account set up now so that you're freely able to do that with your USD, your US dollar currency readily available to make those purchases. And then you could send that to your Ethereum wallet or your Cardano wallet, like your NAMI, or your Exodus wallet, or whatever wallet you might be using, your Ledger, so forth and so on. But that's pretty much it. And the thing of it is that when you're using these, they all generally work about the same. The only differences are the addresses may look different. So, you know, comparing an Ethereum address, which looks like that. So that's your Ethereum address. Typically, they start with 0x in the front. If you are using your wallet and you're trying to send to an address and it doesn't begin with 0x, it's probably not an Ethereum address. And Cardano addresses, for example, are like 3 to 4 times this long. Okay, so it's a huge paragraph of letters, numbers, and so forth. And up here, you'll be able to add additional networks, but we're not going to dive into that because it's not likely you're going to be diving into most of that as a new user in crypto anyway. But you can also lock your account. So let's say you're using Metamask, you've done a couple transactions, somebody sent you something, you wanted to confirm it, or what have you, and you're like, okay, I'm done with this computer, my kids are about to go do their homework, I want to lock the account. If you click that, it will automatically log you right out of the wallet, so you're not going to be able to get access to it anymore. You can also create additional wallets or import additional wallets, and they will just show up here. And that's pretty much it. You can connect your hardware wallet, which we'll probably touch on in a future lecture. But for now, that's how easy it is to send and receive a transaction using a crypto wallet. The only differences are typically the way the wallet addresses look, and ultimately it's all a send and receive, and that's about it. All right, so now we're going to get into exchanges because you're going to be using them quite a bit, more than likely. And they vary quite drastically in terms of how they function, regulation, location, liquidity, all sorts of things. So we're going to kind of go through a rundown as to what an exchange is, how they operate, and some of the nuances about what to look for when looking for an exchange to use. And so here we go. So we're going to start off initially with this website. This is coinpaprika.com, and this is their exchange tab. And on this tab, you're going to see a lot of information associated with each exchange. And these are ranked by volume. Let me see if I can make this a little bigger. Here we go. All right. So, and volume, basically the dollar amount of value traded over a 24-hour period. So, for example, number one exchange in the world right now is Binance with $13.5 billion a day in trade volume over 1,312 markets. A market is basically like a trading pair, like a Bitcoin to USD, something like that. Well, that's a trading pair. I mean, a market is basically, Bitcoin or Ethereum or Cardano, so forth and so on. And that's a big part of why they have so much volume, because they are known to list just about everything at some point. So, well, not really everything. There's 1,300 out of 21,000 different tokens. But if it has any volume or interest whatsoever, I mean, Binance has always been one of the first places you could go to find the ability to trade it. Now, there are a few key things. When I'm looking down this list, we'll see Kraken, okay, and you see this check mark. This check mark means it's an exchange that is regulated or licensed by the respective institution in their localization. Well, Kraken's US based. Coinbase is US based. There are a lot of these check marks. Not all of these are US based. However, Binance, while extremely popular and the most popular exchange, you can't use it if you're in the United States. primarily because of all the stuff that they list that the US doesn't want US investors to get involved with. Okay. And so in order to offset that and to be able to maintain US based traders, they launched Binance US, Binance.us. The volume is significantly less at $290 million a day in trade volume. Still high, but there's only 130 markets. Okay. So there's a lot less opportunity for trading on Binance.us than there is on just trading the regular Binance. But a while back, when Binance announced Binance.us, they also said, hey, you got so long to get your assets off of our exchange because we're going to start locking up US residents from being able to use the platform. But if you're US based and you want a US based, US regulated exchange, you've got Kraken, you've got Coinbase. Kraken's actually grown quite a bit because their volume is gotten much higher than Coinbase. So highest volume on a 24-hour period, 944 million. Yeah, actually the volume is higher on that. I guess it's the ERV volume that's higher. So Kraken has more markets, so they have more various tokens available than Coinbase. However, Coinbase has become one of the more user-friendly, and Coinbase was one of the first US-based fiat on-ramps in the cryptocurrency space in general. So, if somebody was talking about cryptocurrency on Thanksgiving Day to the family and grandma decides she wants to go get some Bitcoin, she's likely going to go to Coinbase, set up an account, add her credit card, and away she goes purchasing her Coinbase. Coinbase used to have an affiliate program where if you set up as an affiliate, somebody clicks your link. Not only does the person that clicked your link, but you as the link provider got $10 worth of free Bitcoin. That was recently canceled, I think, I don't know, maybe almost a year ago, if I'm not mistaken, maybe 9 months ago. So anyway, the nature of a centralized exchange is that they basically all operate off of a central ledger system. And so every buy and sell transaction happens on a ledger system that is ultimately then, like at the end of business day or at the every so many hours or every so many days or weeks even, that ledger system is summed up and, withdrawals and distributions are happening. And what they ultimately do is a centralized exchange generally only has maybe 10% of actual cryptocurrency on the exchange at any given time, and they keep the rest in reserve cold storage. So everything is happening on a centralized ledger system, and it's definitely not happening on chain or in any real-time on-chain activity, okay? Which is also a part of the reason why some of these exchanges used to get hacked a lot more often than they appear to be getting hacked today. But even, if somebody manages to hack a Bitcoin wallet on a major platform and it's only 10% of the reserves, it's still a pretty substantial amount. So it's one of the reasons why they started doing this ledger trading system, these internal ledgers, with the majority of their assets locked away in cold storage, so that they're not accessible by hackers and things. Some other issues associated with exchanges is when you go down the list, you'll see there are lots of exchanges all over the world, and every exchange has different markets, different coins that they list. Like you're looking at YoBit right here, 3,160. And you're thinking, well, how over 3,000 different cryptocurrencies that they're trading, and yet their volume is only like 58 million. Yeah, it's not significantly higher than most because a lot of these are crap tokens nobody cares about. And exchanges like YoBit are very much used for like pump and dump schemes. And pump and dumps are basically, there are Telegram groups and all sorts of communities all over where, every day they might go and they say, okay, well, this particular cryptocurrency that's trading at like 0.5 cents or 10% of a penny or whatever, they're going to pump it up to 15 cents. And then they've got this inner circle and they all accumulate. and then they all start buying it, and then they get these other communities to start buying it, and then when it gets to a certain point, then the original people in the circle start dumping their tokens at significant profits, while everyone else is basically left holding a useless token with the liquidity gone because it's been dumped down. A lot of exchanges are prone to that. YoBit's definitely one that I've always stayed away from because they're and the other thing too is you have these confidence metrics on the right. Now, CoinMarketCap is a very good resource for crypto data as well, but CoinPaprika is the only one that I see with this. Confidence score is our new formula, which is evaluating exchanges on 3 principal matters: confidence, liquidity, web traffic, and regulations. So you can see Kraken, being a US regulated exchange, has a bit of a red bar. It's basically saying they're regulated, and there are watchdogs keeping tabs as to what's going on Kraken. Same with Coinbase. This exchange as well. I've never heard of it. There's so many more exchanges now that I only use a certain number of exchanges because I don't really like to deal in a lot of the really crappy tokens. So I don't really care on speculating with those. Great for bot trading in a lot of instances. If you're automated bot trading, algorithmic trading, which I do as well. But typically I still do that with tokens that I actually like in case I get caught with a bag. So anyway, these centralized exchanges are, to some degree, they're safer depending on what the history of these exchanges are. I typically like Coinbase. I like Kraken. I also like exchanges like, KuCoin can be fun because they'll list tokens like right away. But if the coin doesn't do a lot of traffic or volume in trades, then they'll typically get rid of them. And then outside of this, these centralized exchanges, a lot of them may have affiliate programs that will, cut you in on trade volume and that sort of thing. It's especially big with like a leverage trading exchange, which I'll go over those next. But there are big differences in these centralized exchanges compared to a decentralized exchange. And we'll go over decentralized exchanges in the next video. But primarily as a new user of crypto, I would consider something like Coinbase or Kraken or even Gemini as being your best bets for ease of use, security. I'm not sure to this date Coinbase has ever been hacked. And again, it's US based, it's US regulated. So there are a lot of things that they have to do to maintain security, maintain compliance and things like that a lot of these other exchanges do not have to do. And so I prefer, I prefer exchanges that are regulated personally. I'm not one of those rebels that thinks I need to do everything on a deck so that I'm harder to track or whatever. I'm not one of those guys. So to each their own. But that's ultimately, this is a good resource for finding an exchange. And the thing is whatever exchange you use, you want to make sure that you have high volume, because you need that liquidity to get in and out of positions. As I've mentioned in other lectures, you want to make sure that you're able to get in and out of positions without slippage in either direction. And chances are, starting off, especially at a newbie's position in trading or crypto investing, you're probably not worried about, offloading $20 million worth of cryptocurrency. So you're probably not going to be as worried about slippage if you're talking about a few grand worth of whatever token. So that's the gist of centralized exchanges. Let me know if you have any questions on things that maybe I'm not touching on or explaining thoroughly, and I will do an addendum to this. So we've talked a bit about centralized exchanges. Now we want to dive into decentralized exchanges. Now, a decentralized exchange is vastly different than a centralized exchange, and I'm going to be very upfront with you. It's not anything I would encourage you to use right now. None of these, and you're going to be tempted. The deeper you get into crypto, the deeper you see some of the gain potential of some of the tokens readily available on these decentralized exchanges. Often you're going to be able to get first crack at launch tokens for particular projects you might be interested in, but there are a lot of issues with decentralized exchanges, in my opinion. Number one, they feel and operate in a very insecure way. One of the issues that I see on decentralized exchanges are fake tokens. To give you an example, let's say, let's use Cardano, for example. Let's say Cardano is launching and they're releasing their new token, and they're going to do it on a decentralized exchange first. Well, let's say there's a big FOMO rush and everybody's trying to get these Cardano tokens. It wouldn't take very much for somebody to create an artificial token that does nothing. It just has the same logo, the same name. You can create fake tokens fairly easily. They would obviously not have the same policy ID and the same blockchain data and so forth, but very few people check that stuff when they're using any kind of exchange. And ultimately, you could be spending your Bitcoin or your Ethereum or whatever your primary layer one token is to buy these altcoins and not be any wiser that you're basically buying fake tokens. And because it's a decentralized exchange, there really isn't anybody you can call to get help or to say, hey, I just bought these fake tokens, I want my money back. It doesn't work that way. A decentralized exchange is basically a peer-to-peer. It's like almost like a direct transfer of tokens from one person to another's wallet practically instantly, and it all takes place on the blockchain. So you don't, it's like if a decentralized or if a centralized exchange is more kind of like your bank, where you can go into the bank and they're the middleman between you and a banking transaction, a decentralized exchange is the same methodology between, you know, being able to send value with Bitcoin from point A to point B without the bank. A decentralized exchange is a very similar beast altogether. And the majority of these decentralized exchanges operate using their own token for facilitating these transactions. So that's where you'll see like Uniswap token or PancakeSwap token. They all have these tokens, and oftentimes when a new DEX launches, the value of these tokens goes up quite a bit. Current trading volume right now on Uniswap version 3 is over $1 billion a day, which is pretty significant, and it's up over 25%. There's 800 different tokens available on this decentralized exchange. So, you know, people are using these and using them successfully. But you can also find out that, you know, using some of these exchanges, these decentralized exchanges, when you're making transactions within one of these platforms, you have to basically allow certain permissions and things in your browser wallet. So you have to enable, you have to connect your wallet. Okay. When you do that, you're giving certain permissions for this exchange platform to use your wallet. And then anytime you make a token transaction, little windows pop up. Do you approve this? Do you approve this fee? Do you approve this slippage? This and that. And that stuff can change quite frequently. But you'll notice that it's basically a token swap is ultimately what you're doing. You're not putting in limit orders. You're not saying, oh, well, I'll buy this token for that token when the price reaches X. Doesn't work that way. It's pretty much instant. And it will alert you if the slippage is too high, or you can set your settings to say, oh, I only want like 0.6% slippage. Outside of that, I'll wait. So, you know, to each their own, but when it comes to decentralized exchanges, personally, I just never trusted them. Especially because a lot of decentralized exchanges, they're launched by anonymous teams. And quite frankly, I think anything can happen. And a lot of these decentralized exchanges are, I don't want to say excluded from regulatory authority, but if the team is anonymous and it's all done on the blockchain and there's nothing leading anyone to developers or teams, who do you go after if an exchange or a decentralized exchange were to go south, become a bad actor, get hacked somehow, something of that nature? So, but at the same time, these decentralized exchanges, they're not custody providers. So you're not storing crypto for the sale. You might allocate a certain amount of crypto for a particular asset that you're looking for. And these decentralized exchanges create the liquidity between you and somebody that's either looking to buy or sell whatever assets are being traded. So, you know, I think they're fruitful and I think they're useful, but not necessarily for me. And I've been in the space since 2017. And primarily what I see a lot of volume that I see on decentralized exchanges are a lot of shady, high yield APY type crap coins and things of that nature. And that's just not my bag either. So you'll learn more about decentralized exchanges over your journey in cryptocurrency. But for me, as yet, I haven't really found any significant reason why I want to play with any of them, but to each their own. So now we've talked about centralized exchanges a bit. We've talked a bit about decentralized exchanges. Now we want to learn a little bit about derivatives exchanges or leverage trading platforms. Now, leverage trading platforms or derivatives exchanges, futures markets, that sort of thing, are basically exchanges that allow you to trade with leverage. And these platforms I absolutely implore you to stay away from until you are considered an advanced or pro level trader. Because if you venture off into any of these platforms, you're likely going to make a mistake and cost everything you have. And I mean that. To give you an example, I will show you. So I do some leverage trading myself. And for years, there was a lot of hoopla, myself included, was adamantly against leverage trading. But I'll give you an example of something. Let me open this up. I'm going to show you my exchange here. Maybe. And I don't know why this isn't showing. There it is. All right. So this is my BitGet. Now, BitGet is it's an exchange platform that they have actually paid me to be an ambassador for. That's not why I'm showing this to you here. It's just the only leverage exchange that I actually have activity on right now. So it's easy to give examples. But you'll see right here, I'm currently in a short trade that I got into basically right here. All right. And so I don't know if you need to see my face right now or not, but so currently my short trade is negative $918. And I got into this trade at 16,000. Now, I believe that the price is going to come back down, but I made this trade at a 3x leverage, which basically means that I'm trading at a value 3 times more than I actually put at risk. The higher the leverage that you put at risk, so let's say I made a trade for 8,500 and I went at like a 10x leverage. Well, that 10x leverage means that ultimately my gains could be substantially more because it's as if I'm trading with 10 times the capital that I am. But the downside to this is that if the price goes the other way, I could get liquidated. So on a spot exchange, if I'm buying, let's say I'm buying Bitcoin and I'm trading Bitcoin. If I believe the price is going to go down, then I'm probably going to sell my Bitcoin for cash. I'm going to buy back in when the price is lower and be able to buy more Bitcoin than I originally had, right? Well, in a leverage trade, it doesn't really work that way. It's almost like an all or nothing game in the sense that if the price goes up, I'm going to generate a lot more profit than I would just doing a casual spot trade, because I'm doing it as though I'm using a lot more capital than I actually have. The difference, though, is that if I get liquidated, I could lose it all, which is why a lot of people are in crypto. You'll see, oh, got to take your profit, got to take your profit. You got to use stop losses and things. So I am generally not one to use stop losses. It is definitely something that most people should do. I only trade with money I don't care much about. And not by that, I mean, if something happens, I make a big mistake, I'm not betting the farm. I didn't go mortgage my house. Nothing, it's play money. I consider it play money. A lot of it is I'm educating myself. I'm learning the ins and outs of something. But ultimately, some people could go up to, they'll trade at 100x leverage and basically lose it all or win it all in a matter of a minute. And, I've done calculations in the past, and I don't remember what they all are, but I think it like 100x trade, let's say I were to enter a 100x trade at 16,000 and the price were to go up, I think it was 0.1%. if I did 100x leverage trade short and the price went up 0.1%, I've just lost everything that I put that leverage short in. Okay. Because the higher your leverage, the lower your liquidation window. So like this trade, I'm only at a 3x leverage. So it's basically like I am putting into play more than I actually am. I think the trade was like $8,500 or something to that effect. And you can see down here, it's a 3x trade. My liquidation price is much higher. My liquidation price is $21,271. So the price would have to go all the way back up. And it's not to say that it can't happen, but the price would have to come all the way up here for me to get liquidated. So at that point, it's like, okay, do I believe the price is going to go down further than 16,000 or up higher than 21,000 first? What's going to happen first? Well, I believe the price is going to go down below 16,000 before it's going to ever go back up to 21,000. However, while that may be true, people that use higher leverage means that liquidation price is much lower and lower and lower and lower. The higher the leverage, the higher the risk. Okay. The higher the gain potential, but the higher the risk. I always tell anybody that's trading, leverage trading is a pretty normal practice. It's been going on for decades in traditional markets. You've got options, you've got so many different vehicles for investing, but leverage trading is a big deal. I don't encourage you to do it, quite frankly, especially as a newcomer. Now, outside of that, this isn't a leverage trading tutorial, so I'm not getting any deeper than that, but I just want to show you that that's basically what this is. And you can open limit orders and have trailing stops and all sorts of fun stuff, but I don't really want you guys getting into that until much later on, if ever. So that being said, the question is, all right, what else is there to know about leverage trading platforms? Well, number one, not all of these leverage trading platforms are honest. I mean, I'm just going to put it to you straight up. A lot of these leverage trading platforms, some of them have been known to have internal trading desks that trade against you to try and liquidate you on purpose. Because it doesn't really matter if you do well against their internal trading desk, that means they're losing. If they liquidate you, then they're ultimately keeping all of your capital. And while many will try to pretend that doesn't happen, it's been proven that it does. And with a non-regulated leverage exchange, which just about any leverage trading platform is going to be overseas, not based in the United States. And it's very likely that at the very least, they're going to have a disclaimer saying, we don't want you here. You're not allowed. We don't want to deal with your regulatory bodies because you traded on our platform. Some are a little more lenient. Some may just throw up that warning, but let you move forward. A lot of traders, they'll go to exchanges where they have to use like a VPN or something to mask their IP address and make it look like they're from like Switzerland or something so that they can actually access these platforms. So, depending on your leverage and your experience, you could either be a complete degenerate who just loves the rush of losing money, which obviously those individuals exist. Hopefully you're not one. I don't want to see anybody losing money in crypto. But in some cases people make a lot of money, but at the same time, this is what you have to remember when you're even considering using a leverage exchange. There are people out there with considerably more assets than you do that can more easily control the market against you. Okay. Your $1,000, $2,000, $10,000 leverage trade in either direction, if you're trying to be greedy and make a quick buck, it's much more likely that you're going to get liquidated on either a short squeeze or somebody stomping out a long. I just did an article today where 100,000 Ethereum was just 100,000 long on Ethereum was just stomped out in 1 minute. And so there are a lot of systems to that, and we'll get into some of that information, not as it really pertains to leverage trading, because again, I don't want you to really get involved in it. But it's definitely, there are people out there who intentionally try to liquidate longs and shorts and back and forth. And the job for people that do that is ultimately a market maker. And so when you get into the market maker trading course element of it, or the market maker trading element of this course by a friend of mine who I absolutely adore and is super sharp, you're going to learn a lot about how that whole system actually works behind the scenes, and their methodology, the way they think and why, and how it affects you as a trader. So, but on that note, I actually have some fun with it, because honestly, if I'm bored, I'll do some snipe trades. A snipe trade is like I'm watching a 5 or 15 minute chart. I'm looking for opportunities to make a quick trade, whether it's a long or a short. I make the trade, I get out of it. Typically, it's something I do over the course of an hour or two while I'm working on other things. Swing trades, typically anything above a 4-hour chart to the daily or whatnot. That's typically what's used for swing traders. They're basically getting into a position, looking to get out, within, hours to days, sometimes even weeks, depending on the market. So anything beyond that is generally just an investor, somebody that buys low, holds for years and then sells at the top. I mean, that's pretty much what I've been doing since 2017 for the most part, while I dabble in a lot of these other things. So it's fun to experiment with, and it's you can get a kick out of it, especially, I have some trades where I made like $1,200 in an afternoon. Cool, that's fun. And then like you see right now, I'm in a negative trade. It's down like $900. So, it's an ebb and flow, and there's definitely a system to it. I don't even utilize the trading system for that yet. I'm just going off gut right now. So having fun, but it is dangerous. I could lose everything, and you absolutely could too. So keep that in mind moving forward. Congratulations, ladies and gentlemen. You've completed this introduction course to the cryptocurrency market here in 2024. Now, you're going to notice I had originally created those videos a year ago. Back in February of 2023 is when I launched that free to the world. And I want to show you some things that I think are going to be very, very important for your further understanding as to why those videos are so relevant, and even more so now than they were then. So I'm going to give you a look at something. These are the statistics for the very first video. This was the introduction video to that whole playlist. And if you notice all the way over here, I published that video in February 8th of 2023. Okay. Now I'm going to go over to some charts. This is February of 2023. Okay. So if you look here, February 6th, the price of Bitcoin at the time I released that series was $22,979. Okay. So hypothetically, if someone would have just discovered that series at about the price it was then compared to where it is now, which currently it's at $68,700, that would be 195% increase in price just in Bitcoin. All right. So now you can kind of understand that, this is a cycle. Okay. We've been in this cycle since 2009, and we're getting much, much better at figuring out what's happening in those cycles. Now, what's happening next? See this green line right here? This is the next Bitcoin halving. Okay. What happens after the Bitcoin halving? Well, let's take a quick look, shall we? So the last Bitcoin halving was, I think it was in May, if I'm not mistaken. It was basically somewhere around here. It was about here. I think it was May 11th. So we had the Bitcoin halving right about here, and then we went parabolic into our next bull market run. We peaked, we dumped down about 50%, and then we got a second peak. And this market that we're in now looks much more akin to the 2017 market cycle than it does the last cycle in 2021. And on top of that, what do we have now in this market cycle that we've never had before? We have institutional ETFs. Now, I've done several videos on this. You can find them quite easily, but these new ETFs. These are spot Bitcoin ETFs that basically mean that when they sell Bitcoin to an investor or somebody, and they're, somebody wants to put some Bitcoin in their retirement account or their pension fund or whatever, they're going to use these spot Bitcoin ETFs, which forces these ETF managers like BlackRock and Fidelity and the like to go out and buy Bitcoin at spot prices. And so that has been driving the market up. We hit an all-time highest price in Bitcoin's history. We hit an all-time high in Bitcoin before the halving this market cycle. And it's being more and more widely accepted and widely proposed that we could very much be in a super cycle this time around, which is basically where the price continues to go up or sideways with some corrections in the market, but we may not have that big significant dump at any particular point in time as we move closer to 2030. And there are so many other variables to what's happening in the crypto world and the cryptocurrency tokenization of real world assets, all of this stuff that Larry Fink himself has explained that is going to happen. And it's likely going to happen between now and 2030. You're watching this video to get an understanding as to what is happening in the future of finance, real estate, you name it. If it involves an exchange of value, there's a very good chance that the tokenization of those assets are going to be coming. And when it does, it's going to drive the price of Bitcoin, the digital store of value, the digital gold, even higher and higher. We will see $1 million Bitcoin one day, and that is my belief. That is my opinion. It is not fact, as it has not happened, but I do believe we're getting to that point. And not only that, but when it comes to layer one blockchain such as Cardano, and there are others that are good, but I'm a major Cardano bull for a multitude of reasons. We're also going to be seeing ETFs related to things like Ethereum and Cardano and other major layer one assets. And I'm telling you, the world is going to change before your very eyes. And the fact that you're watching this video and you're getting involved and you're taking action, it says everything. You are learning how to make a piece of that transactional or that transformational wealth that so many of us have been enjoying since 2009, guys like me in 2017. So I hope this video finds you well. Send it to everyone you know that you want to see have a better understanding about cryptocurrency, how to use it, what it all means and why, and make sure you prepare for what's coming, not only just at the end of 2024 and 2025, but between now and 2030, our entire lives are going to change. And where you fall in that pyramid, so to speak, is going to depend on your understanding as to what's going on in the world around you and in the world of blockchain. Until next time, thanks for joining me. I am the Crypto Crow. I hope this message finds you well, gets you a very solid head start as to your understanding of cryptocurrency, and I hope it helps change your life. Thank you. Crow your coins.